I'm Shauna Smith alongside Brad Smith, 30 minutes ahead of the opening bell. The S&P 500 and Nasdaq Composite striving for a fourth day of gains. We got the Dow looking to push higher for the fifth day in a row.
And we're tracking the latest corporate earnings. Shares of Disney, Celsius, and Palantir all on the move after posting quarterly results. And we're looking ahead to Rivian, Lyft, and Reddit after the bell today. Let's get to it with the three things that you need to know. Your roadmap for the trading day. Yahoo Finance's Alexandra Canal, Madison Mills, and Jared Blickery have more.
Hi, Brad. That's right. Shares of Disney are falling on a mixed second quarter earnings report. The company's direct-to-consumer streaming platforms, Disney Plus and Hulu, they're profitable for the first time ever and ahead of schedule. But if you include ESPN Plus, the total direct-to-consumer business still yet to turn a profit, losses totaling $18 million in the quarter. Also, the expectation for the current quarter is softer for those DTC results, and that's in part what's driving shares lower this morning.
And Apple reportedly working on an AI chip to run in AI software data center servers. That's according to the Wall Street Journal. Now, the project is codenamed Project ACDC. It's been in the works for several years, but timing around a launch of this chip is unclear. Apple expected to make announcements around AI at its Worldwide Developer Conference coming up in June. Now, this new chip design could catapult Apple higher into the AI arms race. The street has so far been critical of Apple's lack of position in AI. And it's a big day for Apple here. That tech giant set to unveil new iPad products at an event called Let Loose.
And electric vehicle makers Lucid and Rivian among the top trending tickers on Yahoo Finance this morning. A report from DigiTimes says Apple may be looking into a partnership with Rivian, although it's unclear what the partnership would actually look like. And it comes after Apple canceled its long-running Apple Car project earlier this year. Now, Rivian shares higher on the news, plus earnings are out after the close. And looking at the broader EV space, Lucid under pressure on the heels of results from last night, and Tesla shares also edging lower ahead of the open.
Shares of Disney are under pressure this morning after reporting mixed results for the second quarter. The company's direct-to-consumer portion of its entertainment segment, which includes Disney Plus and Hulu, reached profitability for the first time ever, thanks to CEO Bob Iger's turnaround plan. But Disney still expects softer DTC results in Q3, driving shares lower. Yahoo Finance senior reporter Alexandra Canal has more on this. In the House of Mouse, what are we watching here this morning? I mean, declines by 8%.
Yeah, so we saw these declines extend during the earnings call. I was just listening in, and this largely had to do with comments that the CFO, Hugh Johnston, made about the parks business. He did say that there is some evidence of a global moderation from peak post-COVID travel that will impact demand, and that comes after the company did warn that operating income for the experience business, which includes the parks, that should come in, quote, roughly comparable to the prior year. So some softer guidance for Q3 for the parks business. Also softer guidance in Q3 when it comes to direct-to-consumer streaming for the entertainment division. Now, we did see that turn a profit this quarter. Now, remember, this doesn't include total direct-to-consumer. This includes just Hulu and ESPN Plus. So that profitable for the first time. But if you loop in ESPN Plus in there, we are still at a loss here. Now, Disney said overall it expects its total direct-to-consumer segment to be profitable by the fourth quarter. But I think what this report highlights is a challenge of achieving sustained profitability over time, which obviously is a key priority for Disney, especially as its linear TV business has seen pretty steady declines. We saw that once again in the second quarter. ESPN really struggling with those affiliate fees, with advertising on the decline. So as linear really seems to show a demise here, the focus is on streaming, but we're seeing that it's harder and harder to achieve that, and it's going to be a bumpy road. And on the call, that's what management really reiterated. It's not going to be a linear journey to get to that profitability.
Yeah, and Allie, it looks like we're getting some headlines here right now just in terms of that crackdown. The timing of it maybe is what we're now expecting to see. Disney Plus, the password sharing hearing crackdown is going to start next month. It looks like the crackdown's then going to be rolled out globally in September. So there's that side of the business, but then also what they're seeing on the park side of the business, on the cruise side of the business, when it comes to some of those forecasts and what they're expecting to see with demand. How is inflation playing into that and what that ultimately means maybe for their business here in the second half of the year?
Yeah, the company did say that profits are to be impacted by higher cruise costs due to inflation. So we're now seeing the inflation picture start to play out here, really for all of these companies that are reporting. But Disney, it's especially important because the consumer really drives the bulk of their business. As the consumer becomes more squeezed, they're not going to be spending all this money to go visit the parks business. We're seeing that with the demand warning. They're not going to be spending all this money to go to the cruise line. So this is an interesting development here for Disney, especially because the parks business, it's been this beacon of hope for the company over a very long time. As we've seen some up and down movement across a variety of their sectors of their business, the parks has consistently done well, even throughout the pandemic. So now that we're seeing a bit of a warning here, that's going to be not the best piece of news for investors, which is why I think we're seeing such a sharp reaction in shares this morning.
All right, Ali, thanks so much for breaking that down. Again, shares off just around 7.5%. For a deeper dive into Disney's earnings, we are going to hear from Disney CFO Hugh Johnston. He will be joining Yahoo Finance 9:40 a.m. Eastern time today. You don't want to miss that. All right, well, Apple shares in the green during pre-market trading here this morning. The tech giant reportedly joining the AI chip race. Apple is working on its own chip, and this is according to a report here from the Wall Street Journal. For more on this, Yahoo Finance reporter and anchor Madison Mills joining us now at the latest. And Maddie, when you take a look at the pre-market reaction here to this news, it looks like investors are pretty upbeat about this.
Well, it makes sense that investors would be upbeat about it because in their earnings print, it became clear that Apple can't rely on the iPhone that much longer, right? Investors are looking for some sort of product, some sort of update, and I don't think that's going to come from an iPad. I think it's much more likely that that's going to come from a new chip here. This would be a homegrown chip. Now, it's not clear whether or not it would be deployed, but we do know from reporting from the Wall Street Journal that they're working on deploying this chip potentially in its data centers. Now, this would follow something that we've already seen from competitors in the space. The likes of Meta, Amazon, and Microsoft all use their own homegrown chips to some degree to fuel their AI work in their data center. So Apple has been viewed as kind of late to the game on this. No surprise that they are starting to get in on this project that's codenamed ACDC, which stands for Apple Chips in Data Center. Really innovative naming picture there. But why this matters in the context of the overall tech trade is that we are seeing a potential move for Apple getting into the AI race. Again, this is a move that potentially puts them in competition with NVIDIA. It's also part of the reason that we've seen Intel down so much year to date, if we can pull up the Intel board here, because Intel used to make the chips that some of these big tech names are now creating on their own to fuel the work in their data centers. So investors looking for something new. Again, I don't think it's going to come from the iPad, but I do think based on the number of mentions of AI in Apple's earnings call, it's likely to come from a chip announcement if they can make one.
Well, that's what the interesting thing is, too, because some of the speculation is that if they did announce a new M4 chip for the iPad, then what is the next product it would go into? And most likely one of the MacBooks, because that's exactly where you could see perhaps some of the most crossover in functionality between those chips that are designed here, too. As the rest of us are finna get loose and waiting for this Let Loose event that's going to be beginning in about an hour or so sometime this morning.
The Let Loose event that we've all been waiting for. But it is a great point, Brad, because they have had their own chips that they've used in their products previously. The iPhone, the iPad, the MacBook, as you mentioned. This is specific to the data centers, which is a much kind of bigger ordeal and would set them up again to be a bigger competitor to some of those other names that have been ahead of the curve in their data center AI chips usage there.
All right, a lot more to watch on Apple here on the day. We're going to be tracking the price action during this Let Loose event.
Let loose.
Thanks
Let's
so
go.
much. Yes, exactly. All right, everyone, we're also tracking futures this morning. They're coming in mixed. This after the S&P 500. Actually, right now, we're seeing things positive across the board as the Nasdaq future is making up its mind to the positive side. But taking a look at the 10-year yield, that's dropping for the fourth straight session here we're tracking. This all coming after a weaker than expected jobs report last week, bolstering rate cut optimism. So is the market priming itself for a soft landing? Ellen Hayes, an FL Putnam Investment Management Co-Chief Market Strategist Portfolio Manager, is here with more. Ellen, great to see you as always. I mean, we had Mark Rowan, the Apollo Global CEO, join us yesterday and say, hey, soft landing, it's already here. What say you?
Well, I think it's clear that the economy is slowing, but certainly not so quickly that we're in for a hard landing. I think soft landing does look to be what's going to happen going forward. You see the labor market slowing, you see corporate profits doing actually okay, and you see the PMIs hovering around neutral. So it does look like a soft landing right now.
Ellen, when you take a look at the data, when you take a look at the recent econ data that we are getting out, it's pointing to a picture where the economy is softening just a bit. And I think as a result, we've almost seen this inflation conversation take a back seat. Is that the right way to look at this? Or do you think that this is something that could potentially weigh on the equity markets, obviously, in the second half of the year?
Well, as we look at the equity markets, they're kind of expensive right now, at least on the large cap side. Small and mid cap are cheaper, but I think that's for a reason. So let's set that aside for the moment. So we've already seen a full year's worth of returns in the large cap market. Normally, if you go back 100 years, the average return is high single digits, maybe 10, 11%, and we're already almost there. So I think it would be too optimistic to expect higher equity returns from here going forward to the rest of the year. But having said that, corporate earnings are okay. The one thing that I do think will happen is I think inflation is going to be stickier for longer. We saw a very rapid decline in inflation from the peak in the summer of 22 all the way down to about 3%, but it's been stubbornly there for a while. And with the labor market being as tight as it is, I do think that inflation might be stickier for longer, therefore higher for longer rates. And as we look at some of the areas that are sensitive to rates, that's going to be a little bit more problematic for them.
We've seen a lot of Goldilocks reports really need to be given to the market over the course of this earnings season. And to that end, FactSet saying that on a year-over-year basis, the S&P 500 is being rewarded, or at least rewarding positive EPS surprises less than average. Where does that tell you that there might be some profit taking that could start to be taken at this point in time, and where most notably would that be and show up?
Well, that's an excellent point. If you look at the earnings reported for Q1 in the S&P 500, both revenue or earnings are up around 4 to 5%, which is decent. Forecasts are that that's going to accelerate throughout the year, which I think is reasonable, especially given the year ago comps, the base effects. But as you look at how the stock market has responded to those earnings, what you see is that the earnings beats have been 9% in the first quarter. That is the highest percent beat that we've seen in the last 3 years. And so you would think that the market would be responding positively to that. But because expectations were so high going in, again, we've already had a year's worth of returns in just 4 months. Because expectations were so high going in, the average stock that beat was actually down on the day, the lowest response in the last 3 years. So I think what that's telling us is A, corporate earnings are fine and healthy, and that does reinforce the soft landing narrative. But expectations were high, and there's just not a lot of upside to the markets from here, given where we are already. Now, the one thing that could make that better would be if we saw corporate earnings accelerate. But with inflation remaining stubbornly high around 3%, I don't know if that's possible. I think what we see for the rest of the year is continued choppiness.
So you said that the movement here to the upside might be limited then at this point. How much higher then, or lack thereof, do you think the equity markets could go between now and the end of the year?
Maybe a few percentage points, but I don't think we're going to see another 10% from here. You could see another 5% from here, but I think it's going to be choppy between now and the end of the year. And another aspect that you see as you look forward at earnings estimates is that right now, tech and communication services, which of course have been the big winners for the last several years in stock prices, but also in earnings, they had the fastest earnings growth in Q1, and in Q2 they will also. But if you look at earnings forecasts by sector for the rest of the year, what you see is that a lot of other areas are going to catch up. Healthcare, materials, industrials, that's going to be where the earnings growth is faster toward the end of the year. So you could see the overall averages remain roughly where they are, but a rotation under the surface towards some of these areas that are going to show the accelerating earnings growth later on in Q3 and Q4.
As there's a lot of upfront spending on building out the future data centers or the future that is going to be the infrastructure for generative AI, does that mean industrials perhaps are the next big kind of picks and shovels type play for generative AI?
There are a lot of factors that go into building a data center, right? You need land, you need materials, you need construction and engineering, and of course, you also need chips. So I think it's going to be all of the above type of thing as the data centers continue to get built out over the course of this year. And there are other factors too, right? It's not just AI. You have the Infrastructure Reduction Act, you have the energy transition still going on. You need a lot of energy for that, so that's going to be electricity. So I think that there are a lot of bank shots that you can make in addition to simply owning NVIDIA.
Well, you classify that, bank shots. Okay, bank shots for generative AI. Ellen Hazen, thanks so much for taking the time here with us. FL Putnam Investment Chief Marketing Strategist and Portfolio Manager. Appreciate the time here today.
Thanks for having me.
Everyone, we're just getting started here on the Morning Brief. More trouble for Boeing as the FAA opens a new investigation into the inspections of its 787 Dreamliners. We're going to discuss that next. Plus, shares of Disney falling on a mixed second quarter earnings report. Stay tuned for our interview with Disney CFO Hugh Johnston. That's coming up at 9:40 a.m. Eastern Time. You do not want to miss that. And plus, we've got something for the crypto curious out there. Bitcoin hovering around $63,000 as its volatile run continues. Stay tuned for Catalyst, where Shauna and Maddie are going to speak with Pomp Investments founder Anthony Pompliano. All that and much more. You're watching Yahoo Finance. Palantir shares sinking this morning after its full-year revenue outlook came in below expectations, but the company's first quarter revenue did rise 21% from a year ago. Palantir CEO Alex Karp writing in a letter to shareholders that its U.S. commercial business will be, quote, one of the most significant drivers of growth in the near term. You're taking a look at shares right now. They are down by about 12% going into the start of today's trading activity. I got to tell you, I read through this investor letter this morning, and my goodness, I mean, it had Tortured Poet Society energy all over it. I mean, it was talking about war and how critical this business is in the future of AI and how that is ultimately going to be used as perhaps a defense mechanism. So it got dark towards the end, but at the end of the day, it's clear that they are signaling Palantir is still going to be a driving force in a lot of the different AI solutions that different countries and companies within those nations also need in order to power, their own, I guess, defense, cybersecurity, you name it, type of mechanism here. But still, growth they're foreseeing in the near future here too.
Yeah, they are seeing growth, but I think the question here for a lot of analysts and maybe why the stock is off so much here in pre-market trading is just exactly what that growth is going to look like given in the near term, and then also given the current valuation of the stock, right? Heading into this print, the run-up that we did see in the stock, lots of analysts ahead of the results were questioning exactly what that reaction is going to be. The high expectations, that high bar that Palantir needed to clear in order to satisfy the street. And we could see as a result of the pre-market action that it wasn't enough here for investors. And you have Morgan Stanley's Keith Weiss saying that valuation remains stretched and therefore tilting the risk reward here to the negative side. And then William Blair's Louis DePalma, the analyst there, saying that the stock is likely down because of U.S. commercial revenue growth, which sharply decelerated from the last quarter. And why do we bring this up? Why does this matter? This is the focus here amid that AI push that we have been talking about here for Palantir going forward. So I think there's lots of reasons to be optimistic. And Dan Ives, in his note this morning, was focusing on maybe those longer term plans and exactly how big of a player Palantir is going to be within the AI space in years to come. But I think the immediate reaction in the stock today, a lot of that having to do with the current valuation of Palantir.
Yeah, it really signals a company that's really confident in the strength of their own software products, talking about how they're letting companies simply and these potential partners use the software, let them decide what works, what does not for themselves, and that gives them a little bit more agency to be able to make the purchase decision based on the effects that they see that it has for their overall business here. But it's a different type of approach that Alex Karp was talking about. They're actually enacting with that strategy in itself, almost like a freemium model, if you will, but a little bit more expansive than that and much more dollar signs or commas in the dollar sign.
But he's hoping. All right, but again, Palantir shares off just about 12% here in the pre-market. All right, let's shift gears and talk about the EV space. A number of headlines here this morning. Apple reportedly considering partnering with a U.S. EV startup and eyeing Rivian as a possibility. This is according to the DigiTimes. Now, Yahoo Finance's Pras Subramanian has the latest details on that report. Pras.
Yeah, hey, Shauna. Yeah, heavy speculation here from the DigiTimes about that. Basically reporting there's been some contact on a partnership, no real details given, but DigiTimes suggesting that because Apple has spent upwards of like $10 billion on self-driving tech and car tech, this could be used with Rivian vehicles. We know Rivian could use the cash, right? They're investing heavily in their new cars. The report also suggests that because Amazon is a Rivian partner and Amazon has better AI tech than Apple, the three could all do something together in some fashion. Very fun to talk about, very speculative, but of course, big tickers for us, Apple, Rivian, and of course, Amazon.
Another big ticker here, Pras, Lucid. Lucid shares sinking after reporting a wider than expected loss in the first quarter, but the EV maker did confirm its Gravity SUV. Ooh, nice. It's still on track for a 2024 or a 2025 debut. What can you tell us there?
Yeah, hey, Brad. Yeah, late 2024 debut for that Gravity SUV, highly anticipated SUV type vehicle that everyone thinks will be kind of including CEO Peter Rawlinson, will be a volume seller for Rivian, for Lucid. But sort of back to the earnings, reported last night. Revenue beat here, actually, pretty strong revenue beat here, but a wider than expected profit loss, EPS loss, and also adjusted EBITDA loss wider than expected. The company keeping its 9,000 vehicle production figure, which is nice to see. But also, it's the big deal is that 2024 debut of the Gravity. So also that's coming up. But also, I want to mention something else. It's the question of how long can they keep losing money, right? That's a big question that came up on the call. Margins were a question. They don't actually officially report margins for its vehicles, but I spoke to the CFO last night and he said that the margins have actually improved sequentially. Now, the price is still negative, but they've been improving sequentially as they work on things like logistics and supplier costs and things like that. And I asked about the Saudi investment, the PIF, how that's going, what's the kind of future of that. And CEO Peter Rawlinson told me that it's that Lucid is a cornerstone investment for the PIF and its sort of Vision 2030 fund, and that they think that as the Saudis are on board, the Saudis believe their technology is the best at Lucid, so that's why they think that partnership can go on for a long time. And right now they have around $4.5 billion in cash, which would give them runway through the second quarter of 2025. So that's a positive there for the company.
All right, Praz, thanks so much for breaking down those stories here for us. Let's talk about another trending ticker here on Yahoo Finance, and that is Boeing. More trouble for the company. The FAA has begun a new investigation into the plane maker after telling the regulator back in April, Boeing telling regulators back in April that it may not have completed the required safety inspections on some of its 787 Dreamliners. Now, the FAA is saying in a statement that they are currently investigating whether or not Boeing employees may have, quote, falsified aircraft records. So clearly this is another issue here for Boeing. We saw the reaction in the stock yesterday, late in the day, and trading off another 0.3% here this morning. As it stands right now, the Dreamliner production is still moving forward as planned. We haven't seen any delay as of right now, but the FAA pushing Boeing, saying that they must create a plan to address the 787 planes that are already in service. So again, this is just another issue for Boeing. And then we also had the delayed launch last night as well, which is adding some uncertainty to the stock.
A little bit. I mean, look, it's a day that ends in Y, so there are multiple headlines swirling around Boeing right now. One of them also being Spirit AeroSystems, which is reporting earnings here on the day, and they even within their earnings talking about the discussions. This should not be new to investors. Boeing talked about this in their most recent earnings call, saying that discussions with Spirit were ongoing. As with any large and complex deal, number of terms and issues that they're still trying to work through, including price, financing, and other key items. And if you were to take a look at Spirit AeroSystems, their market cap here on the day, one of the huge things that you'll remember is that even as the company carries a market cap of about $3.8 billion, the larger question is what type of premium would Boeing feel convicted to even slap on top of that? And Spirit shares have really teetered with that in regard. A lot of investors trying to get a best sense of what type of premium Spirit AeroSystems actually deserves at the same time that they're doing their own cost management. And I think for the hit that they're going to be seeing on the 737 production, that's come back into the focus and the foray here this morning as well.
Yeah, and it's also interesting when you take a step back too and look at the stock reaction to all of this. Yes, they did have earnings, but even the fact that the stock is still lower despite the confirmation of those merger talks. And I think a lot of that points back to the wider than expected losses that we are seeing here for Spirit AeroSystems. Again, the stock off just about 2%. Well, we are just minutes away from the opening bell on Wall Street. We're taking a look at some of the biggest movers here ahead of the opening bell and also how the trading day is shaping up. We'll be right back.
Welcome back, everyone. We're getting close to the opening bell. Let's do a quick check of the market, sponsored by Tasty Trade, as the opening cross is just seconds away here. And we'll take that market check in a hot second here as the futures were pointing positive. Hey, yeah, big storage wars energy at the NYSE. Public Storage ringing the opening bell there. Of course, not the sponsor of Storage Wars, but just a fun show to watch. Anyway, the Nasdaq Composite, the Nasdaq Composite's higher, but hey, take a look at the Nasdaq 1-800-Flowers I was telling you about.
I know, you have a great memory. How many years ago?
Oh, it was many moons ago.
Many moons ago.
My mother and I, yes. I was able to have my first bell ringing ceremony with my mother at the 1-800-Flowers ceremony. They do it ahead of Mother's Day. Shout out to all the moms.
Were you able to get a bouquet? Thank you.
We did get her a bouquet, yeah. There was mad flowers there.
All right, let's take a look at how the trading day is shaping up. Like Brad was just saying, we are seeing gains across the screen for all three of the major averages. You got the Dow just above the flat line here in early trading, taking a look at the S&P 500, getting closer and closer to that 5,200 level, and then checking in on the Nasdaq Composite here. A bit of a move here to the upside, just not too far from the flat line. So again, some important trading action to keep in mind here this morning. Let's also take a look at the sector action and how that is playing out on an intraday basis. You can see consumer discretionary, communication services in the red once again. In terms of the leadership, we're looking at real estate and materials among the biggest gainers in today's action. You've got real estate up just about 0.7%, and then consumer staples, some big earnings report out ahead of the bell for that sector. We're seeing that among the winners here in early trading. All right, Jared Blickery is standing by for the closer look at some of these early moves. Jared.
Thank you, Shauna. Just want to follow up on yesterday. I was talking about the 50-day moving average, and all the major indices now have a 50-day moving average, and I'm going to put it up here where prices cleared it. So you can see now we are in our second day after getting that nice close yesterday. That's the S&P 500. Here is the Nasdaq even farther along to the north side, and here is the Dow. And just by way, I was writing in the morning brief a couple weeks ago about expectations for the market through June, and we do have some seasonal weakness. Notwithstanding, we were due for a bounce because we had got oversold. So putting it all together, we probably have a run at these record highs here for the various indices, but can we go much further? Might have to wait till later in the year. Also want to point out what's going on in volatility. I'm going to put these, take off the 50-day. There we go. We can see the VIX at the lowest in months and the VIX of the VIX. And yes, there is a VIX of the VIX. That is the lowest since about 2015. So pretty impressive to see that. I am seeing a lot of broad strength today. I'm going to skip right to meme stocks because this is something that really caught my attention. This is what's happening today. Palantir down 10%, but here's the 4-day view where you can see just a ton of green here. Coinbase up at 9%, Robinhood up 7%, and a lot of stocks up even more than that. Cost in the pole position up 44%, guys.
All right, Jared, thanks so much for breaking that down for us. Well, it's a busy morning in the EV space. A report out overnight saying that Apple may be considering a partnership with Rivian, coming ahead of Rivian's results after the bell today. And then we got news out of Lucid. Shares are sliding as the company expects to spend more while keeping production at the levels that missed expectations. The weakness also weighing on shares of Tesla here. A different report out, though, on Tesla, which is also getting hit on report here that sales in China were coming in a bit weaker than expected in April, sliding for the month of April. Joining us now, we want to bring in Seth Goldstein, Morningstar's equities strategist. Seth, it's great to have you here, sir. I don't even know where to start, but let's start with Lucid, since we are seeing the biggest reaction here in shares, at least to their earnings report that was out yesterday after the bell. When you take a look at the slide that we're seeing there, what does that tell us just about overall demand for EVs? Because yes, deliveries coming in better than expected, but there's still lots of reasons to be a bit cautious here in the short term.
Yeah, when you look at Lucid, so deliveries grew. And so when I look at a high-end luxury vehicle demand for Lucid's consumers, we're still seeing that many consumers still want Lucid. They're still growing, which tells me there's still plenty of demand for their vehicles. But for Lucid and for other companies that are younger startups like Rivian and so on, the big question is, can they mass manufacture vehicles at a profit? And we saw with Lucid, they're still losing about $118,000 per vehicle on a gross profit basis. And I think the market's reacted negatively to that because they want to see closer moves towards profitability, a path to mass manufacturing profitability that they want to see from startups.
Do you think that there's a path to profitability on the type of EV demand that we're seeing right now?
I think for Lucid, with the high-end luxury market, there is a path to profitability, but it's a question of can they achieve that? You know, it's going to be it's very difficult to profitably make autos. We've seen multiple bankruptcies from EV startups that just came to the market a few years ago, and so it's on management to try to drive down manufacturing costs, realize manufacturing scale as quickly as possible, so they don't have to keep tapping the financial markets or potentially look at going under.
So another big headline here in the EV space this morning, Rivian potentially maybe partnering with Apple. No real details on what exactly, if in fact we do see that partnership, what it's going to look like. But I'm curious though to get your perspective. If we do see Apple still interested in the EV space, what is that going to do you think, for the industry?
Well, Apple has a lot of really strong technology, and Apple would certainly have the balance sheet to throw a lot of money behind developing EV technology. Partnering with an existing manufacturer like Rivian sort of accelerates that development, because remember, Apple scrapped their EV project. I think they didn't want to start fresh and build their own car, but a partnership route seems to make a ton of sense since EVs are a growing market. And I think Apple's looking at this as a new device per se to grow their technology and grow their revenue with a new end market.
And so for Apple and Rivian to be able to get this right, where do you believe that Apple would need to ultimately see the biggest additive to their business? I mean, where does it make sense for them to see some type of benefit? And for Rivian, I mean, does this just mean, hey, we'll be able to sell more units, more R1Ts or more R2s or R3s, wherever we're going to be expecting those soon?
Well, I think for Apple, they could look at this as a new platform. So perhaps the operating system of the electric vehicle. And so for Rivian, you are adding your vehicles to the Apple ecosystem that allows many users who are maybe interested in a higher end luxury EV in the first place would consider that to be able to more seamlessly get in their vehicle. And I know Apple CarPlay is in many vehicles. And so that creates easy transition when you're getting in your vehicle. But if Apple can more seamlessly find a way to partner with Rivian, that could increase consumer demand for Rivians too.
All right, Seth, and you cover Tesla. So let's talk about the headlines that were out today on Tesla. We're getting some new data, preliminary data, I should mention, from China Passenger Car Association, showing that Tesla sales in China for the month of April actually slid about 18% on a year-over-year basis. How are you looking at this from an analyst perspective? Exactly, I guess maybe is the worst not behind it then for Tesla when we're talking about demand, and especially what we're seeing out of China, which is an extremely important region here for the company?
Well, I think what we're seeing is new energy vehicles continue to grow in China. And if we assume that the report is correct, the final numbers come in, Tesla saw an April year-over-year sales decline, then it shows that the reason why Elon Musk is making larger transformational reorganizational changes at the company and why they cut prices in China towards the end of April. That combined with the trade-in subsidy that the Chinese government issued towards the end of April, I think will help Tesla to set themselves up for a better rest of the year. But, if they do have another month of declining sales, I think now we're seeing why Elon Musk is taking a lot more what might be seen as drastic steps towards, righting Tesla's employee side, trying to reduce costs and trying to reduce prices to spur vehicle growth.
Seth, can Tesla compete in China in the long run? When you take a look at the domestic players, much cheaper offerings than what Tesla is able to compete with. Yes, they have slashed their prices, but what is 3 to 5 years out? What does that look like then for Tesla, do you think, in the Chinese market?
Well, I think for Tesla, the important thing is that they can now sell FSD in the coming months. And that is a differentiator of Tesla's technology versus many other EV producers. So I think for Tesla within China, they're not in the affordable vehicle market. So yes, there are a lot of longer range, cheaper EVs out there. And for consumers who only care about price, Tesla is likely not going to be the go-to choice in China right now. But Tesla can still compete in the high-end luxury market on a technology standpoint with FSD, and I think that can help them to drive sales over the next several years, assuming that for their entry-level luxury space where the Model 3 and the Model Y compete, that they're at a comparable price with their peers.
All right, Seth Goldstein, we have to leave it there. Morningstar equity strategist, thanks so much. Well, coming up, Disney shares sliding on a mixed report. We are going to hear from Disney CFO Hugh Johnston on the other side of the break.
Disney earnings are in focus after the company pared its losses in its really important streaming business. Let's bring in Disney's CFO, Hugh Johnston. Hugh, good to see you. It has been a while. Welcome back to Yahoo Finance. Let's start on that streaming business. The company pared its losses, the operating losses, to $18 million compared to $659 million last year. I guess one of the biggest questions investors are probably wondering, is that sustainable?
Yeah, good morning, Brian. We think it is. We feel terrific about the progress we've made on streaming. Obviously, we focused on both the cost side and the revenue side, and both are delivering. The streaming business grew 12% in the quarter, which is obviously a nice, healthy number for us. In addition to that, we're managing our spending much more efficiently. So we will go negative in Q3 a little bit more based on the timing of some cricket rights. But as we've indicated before, we'll be profitable in Q4, and we expect to build on that in 2025.
Yeah, it looks like you had a good, successful quarter, Hugh, in Disney Plus subscriptions. Now, that comes after Disney Plus took price hikes, in the fall of last year. Just given that momentum, do you think you have more room to push prices?
Yeah, we think we do. I think you're going to see prices steadily go up over time in the streaming service, mostly because the content we have is worth paying for. So obviously we generate a lot of our own IP, both on the television series side as well as on the movie side. And in addition to that, as we continue to build out the streaming service, in particular, putting an ESPN tile on later this year, and then adding ESPN Flagship as an option next year, we think there's just going to be more and more value there for consumers, and they'll be willing to pay more for it.
On the streaming business, Hulu subscriptions only up 1%. Now, you're trying to, I guess you're working with advisors. You have come up with a valuation on what Hulu, that remaining stake, is worth. Comcast has its valuation. Do you even need Hulu as part of the portfolio? 1% growth, it's not mind-blowing to pay maybe potentially $28 billion for the rest of this asset.
So I'm not going to say much about a negotiation that I'm in the middle of. I've got a pretty good discipline about talking about deals after they're done and not before they're done. That said, we already own 2/3 of Hulu, so it's already largely a business that we are in control of. We'll see where the negotiation goes from here, but we're continuing to work our way through that.
Fair enough. On the linear operation, help investors understand this asset. So the sales were down, the profits were down. What do the next few years look like for this asset, and what do you have to do to improve operating profits?
Well, I think it's important to think about entertainment in totality rather than thinking about the individual parts, because essentially it's the same consumer. They're shifting from one distribution channel to another distribution channel. So as we see growth in streaming, obviously those are the eyeballs that oftentimes previously were in the linear business. I tend to look at it more in aggregate, and as I look at it in aggregate, I think we've got a business that's got the potential for good, healthy top line, and over time will actually increase margins on the streaming side as the linear side continues to erode a bit. That said, I do suspect we're going to hit a point where the linear business will start to level off, because people do choose to leave for certain reasons, and for a lot of people, they choose to stay. Eventually, we're at the point where it's just the stayers that will be there.
Is the business still being reviewed for further cost cuts?
Yeah, I mean, any time a business is losing revenue, you have to look at it for cost cuts. And I think the team is doing a terrific job trying to come up with creative ways to produce television programs more cheaply, share resources where it makes sense, take a hard look at really every dollar that's being spent and say, okay, is this one that's necessary, or are we better served cutting that dollar and putting it elsewhere in the business so that we can continue to drive growth as an overall company?
I'm sure you're watching, you and the team, Hugh, on what's going on, the drama around Paramount. Wherever that asset ends up, how does it impact your linear networks?
I'm not sure it's going to make much of an impact on us, to be honest with you. I know they've got a lot of sorting out to do over there, so we're not really a part of it. So I couldn't tell you where I think it's going to go, but we're sort of focused on making sure we deliver the best content to consumers with our business, and then we'll let the chips fall where they may.
Big quarter from the parks business, Hugh, especially international. What are you seeing there?
Yeah, the growth has been terrific in parks. 10% revenue, 12% OI, and the parks specifically component of it actually grew OI 13%. International continues to lead the way for us, and it's very broad-based. All the parks are making money now. We're seeing very strong business in Paris, very strong business in Shanghai. In addition to that, the Hong Kong business is doing well. And the business in Tokyo has been quite strong. So feel very, very good about those businesses. And candidly, I think we've got lots and lots of potential future growth in parks on the international side.
I'm one day into the Milken conference, Hugh. That's where I'm doing this interview. And lots of chatter, I think, on signs of a U.S. economic slowdown. Of course, we had some problems or slowdown in the recent GDP print. Are you seeing any signs of a slowdown in summer bookings at Disney?
We haven't seen any of that at this point, so we certainly feel good about that. Now, as I understand it, the lower income consumers, sort of in the lower deciles, are the ones that are feeling the pinch a little bit more. But even for those consumers, the family vacation is one that's kind of a priority for people. So when they're making decisions around what to cut, we typically get cut a little bit later than most. So still feeling good optimism about travel in the U.S. and in particular feeling good optimism about people coming to our parks.
Before you came to the company, Hugh, as CFO, there was a target put out there on CapEx investing in the parks business. Really, it was a mind-blowing number, $60 billion over 10 years. Now, the CapEx increased slightly in the most recent quarter in the parks business. Are you still committed to that $60 billion number?
We are. That number is still very much intact. Now, keep in mind, that's not an incremental number. That's a total spend. On a normal basis, we probably would have spent somewhere in the $30 to $40 billion range anyway. The reason we're doing it is the parks business has so much in terms of growth opportunities. The returns on invested capital are terrific in that business. The margins, as you know, are in the mid to high 20s. So if you're going to invest, those are the types of businesses you want to invest in. And I think we're going to get terrific returns for shareholders out of those investments.
And lastly, Hugh, of course, this is the first quarter earnings being reported after the battle with activist Nelson Peltz. You battled this guy twice. Of course, at PepsiCo now and coming here at Disney. What has this experience been like, and what is it like for a big company like Disney to go through this type of situation?
Well, candidly, it was a bit of a distraction for a couple of members of the senior team. That said, look, the management team under Bob is focused on creating value for all the shareholders, not just one or two of the ones that tend to be a little bit more talkative. And as long as we keep our eye on delivering value for all the shareholders, I think we'll be in a terrific spot going forward.
Well, Hugh, I didn't slip and almost ask you a PepsiCo gross margin question, so I'm proud of myself, and I am proud of you for not even bringing up the company. Hugh Johnston, always good to see you. Thank you for making time for Yahoo Finance. We appreciate it. We'll talk to you soon.
Thanks, Brian. Great to be with you guys.
Tesla CEO Elon Musk makes an appearance at the 27th annual Milken conference. The billionaire covering a wide range of topics during the Q&A, all except for one. Here with all of the details, we've got Yahoo Finance's Yasmin Khorram. Yasmin, what did he say? What didn't he say?
Well, he said a lot, but if people were expecting to hear about the recent Tesla layoffs or the much anticipated robo-taxi, they may have left disappointed. Elon Musk spent the entire 30 minutes on stage with Michael Milken talking about everything but Tesla. Instead, he went into long explanations about space exploration, free speech, illegal immigration, declining birth rates. He told the audience that everyone there should at least have 3 children. At one point, he even chuckled while reading an audience question. He read it out loud. It said, quote, "Elon, come pick me up and I'll give you a baby." But it wasn't all light banter. Elon Musk did talk about AI, and he said it is the most important question.
Eventually, the percentage of intelligence that is biological will be less than 1%. Almost all intelligence will be digital. So then it's like, well, what role will there be for us? I don't know. I do think it's very important that we build the AI in a way that that is beneficial to humanity. I've thought about AI safety for a very long time. I think you want to have a maximum truth-seeking AI. This is very important.
When asked if AI could accelerate his work in the space industry, he didn't seem too jazzed about that technology. He told us that his 2 other companies, SpaceX and Starlink, use no AI. But guys, this was a primetime slot on the first night of Milken. It was very much anticipated. The line to see Elon talk was out the door. It spanned the entire length of the Beverly Hilton. A lot of us were hoping to hear him talk about Tesla and possibly even X, but we were left with a pretty broad, futuristic conversation.
Yeah, a bit of a surprise. We were expecting to hear a bit of more commentary specifically surrounding Tesla, or maybe hoping, I should say, to hit more, to get a little bit more color from him about that. Yasmin, great stuff. Thanks so much. Well, more than 80% of the S&P 500 companies have delivered their financial results for the first quarter of 2024. And Wall Street is already getting bullish on the second quarter. This is all according to FactSet. Now, the reason we bring this up is because I think the focal point, at least over the last several weeks, have been some high-profile misses when it comes to AI and the AI story and exactly maybe what that could spell out then for the market, at least in the short term. But when you take a look at the numbers beyond those worrisome headlines, when you take a look at growth, we were talking to John Stolfus about this yesterday on Yahoo Finance. He was saying we've actually seen the strongest earnings growth in nearly 2 years, coming in at 5%. When you take a look at the revenue growth, some of those numbers that have been reported so far this earnings season, also very impressive. So yes, we are starting to see maybe some cracks when it comes to the AI story, at least in particular when it comes to current valuations. But there is still a lot. I think my takeaway so far from this earnings results period has been there's a lot to be positive right now in the markets and believe here that at least some of that momentum can continue.
Yeah, and if you look out continuing here, you know, some of the sectors that are ultimately providing some of the boom, at least provided some of the boom in Q1. It was led by healthcare and consumer discretionary sectors, the companies that were reporting positive earnings surprises by companies in multiple sectors. And the larger question is how much of that could continue into the next quarter here as well, and what would be the overall theme or the, catalyst, which would push these companies further. And generative AI seems like that theme is fading as of right now, as that's actually going to hit on some of the earnings for some of these larger companies that have announced big spending plans, big CapEx that's going to be coming forward in the quarters to come, especially as they try to get their hands more on the demand environment for AI right now.
All right, well, speaking of catalysts, let's get right to it. Madison Mills is going to be joining me here for the next hour. We are going to continue to dive into Disney's latest earnings results, as well as reports that we're getting of Apple developing its own AI chip.
Yeah, set them up, you knock them down. And I will be back for 1 hour's time, in 1 hour's time, for Wealth, where new data is showing that consumers are getting fed up with big brand food costs. This is Yahoo Finance.
It's 10 a.m. here in New York City. I'm Madison Mills alongside Shauna Smith. Welcome to our new show, Catalysts.
From equities to commodities, we are decoding trends and uncovering the drivers behind today's market moves.
Our team of experts here to help you navigate all possible outcomes to make the best decisions for your portfolio.
It's Tuesday, May 7th. Let's dive right into the catalyst moving the markets this morning. Well, Disney shares down after the company reported a weaker profit outlook than expected and missed on streaming subscriber numbers now. The company's direct-to-consumer streaming platforms, Disney Plus and Hulu, those are profitable for the first time ever and ahead of schedule. This marks Disney's first earnings report since winning its proxy battle with activist Nelson Peltz.
Plus, Apple is reportedly working on a chip to run in AI software data center servers. The project is codenamed Project ACDC, according to the Wall Street Journal. And this comes as the tech giant is also unveiling new iPad products at an event called Let Loose. Those shares up over 1% today.
And Boeing extending losses after the Federal Aviation Administration, the FAA, launched a new probe into the aircraft maker's 787 Dreamliner. The company alerted authorities to potentially incomplete inspections on the jetliner. Boeing spokesperson telling Yahoo Finance, quote, "We promptly notified the FAA, and this is not an immediate safety of flight issue for the in-service fleet."
Let's get to our top story of the morning, Disney's earnings. The company's stock moving to the downside after mixed results. So for more on Disney earnings and that share down a little over 8%, we're going to bring in Anthony Forcioni, Rockland Trust Vice President and Portfolio Manager. He is also a Disney shareholder. Anthony, thank you so much for being here this morning. I want to start by asking you about Disney's pricing power, because I'm curious how much pricing power you think they still have and whether to you you'd view this earnings print as defensive in terms of cost cutting or potentially offensive and showing you that there's more growth to come for this name.
Good morning. Thanks for having me. So in terms of pricing, they definitely have a lot more pricing power within their portfolio. Today's print certainly brought a little bit more exciting action than I would have imagined. I mean, when you look at the numbers, they were a very solid quarter. Raised guidance for the year, reiterated their outlook on free cash flow and cost efficiencies. But at the end of the day, I think the market probably wanted a little bit more and was a little bit worried about sequential guidance in their theme parks, which when you take out the one-time costs are going to be completely in line. So when you look at pricing, they do have still power in their theme park, and then certainly within the DTC business as they continue to optimize that model.
So, Anthony, is this a buying opportunity then when you see the stock off 7.5%? Is this a reason then maybe to get in and position yourselves for those gains?
Yeah, I think when you take a wider lens, the longer term opportunity is still there. When you look at the DTC business, we've got a great view on this business. When you look at Netflix's business, while not exactly the same, certainly comparable enough to say this business is entitled and should get margins in the mid-teens or perhaps even higher as they continue to evolve the model internationally. And that equates to $3 billion plus of operating income and $2 plus in earnings power. And I don't think that's reflected in the stock yet. And I think what investors are also underestimating is this cash flow continues to compound. There's optionality in terms of returning capital to shareholders that's not reflected in the stock. So I think the risk reward is still good.
But when do you think we might get that capital returned to shareholders then?
Yeah, we're already seeing it. They repurchased a little over 1 billion shares this quarter. They instituted a dividend also recently. So that is happening. And I think will continue to happen as they continue to compound cash. And I think another strong element is that, it's been an unprecedented time in their studio production. And that should be a lot better going forward that, continues to energize the flywheel they have.
Anthony, when you take a look at some of the headlines that came out of the earnings call here earlier this morning, they talked about the third quarter profit to be impacted by cruise costs, by inflation. They also went on to say that parks growth was, quote, moderating from peak post-COVID levels. When you take that into account, how big of a challenge of a headwind do you see inflation if we do remain at these levels, stickier than many had forecasted to be at this point? How big of a headwind is that for Disney, at least in the short term?
Well, it's somewhat of a headwind for Disney as they're a consumer-facing company, and they talked about that with higher wage costs for their business. But ultimately, I think it falls back onto the pricing power they have. They provide a very, very unique experience to consumers. And when you think about the theme park business, again, looking at a wider lens, I have no concerns over this business over the longer term. It's a fantastic business. They're going to be putting a lot more capital into it over the next 10 years. tremendous opportunities for expansion and invigoration in terms of new attractions. So I think this business is going to be much bigger over the next 10 years.
Well, I'm curious, too, about the streaming business, Anthony, because I know that there have been questions, especially to the CFO, who we spoke with earlier, the Yahoo finance team, about Hulu's valuation and any potential deal-making surrounding it. Are you looking to hear more information about a potential deal, and would that make you more bullish on this stock?
Yeah, I think we are going to hear more news in the coming weeks and quarters, certainly on Hulu. They've got to decide on the right valuation, and I understand they're bringing in a third-party evaluator to do that. And I think that'll be settled shortly, and probably acts as sort of a near-term catalyst to sort of have that behind us. You know, and that's a huge opportunity. And they talked about it in the quarter a little bit, how they've added the Hulu tile within Disney Plus, and that should increase engagement, lower churn, lower marketing costs, and then, you know, ultimately continue to build value for the franchise.
And then when we talk about the longer term prospect here of Disney, we got to talk about succession, what exactly Disney is going to look like under Iger. What are you hoping to hear in the coming quarters, and how do you expect this to play out?
Yeah, it's a great question. We heard about it a little bit on the call today, how the board is obviously very focused on that's a succession planning. Ultimately, you know, they're going to work with Mr. Iger and settle on when it's the right time for him to leave. But it's a really important decision for them, given the recent management changes that they had. So I think this is a really, really important point for the board to do this properly and correct, and, you know, take on this actually very difficult challenge of finding the next CEO of Walt Disney Company.
Anthony Forcione, we really appreciate you taking the time here joining us this morning. Rockland Trust Vice President and Portfolio Manager. Thanks. Keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back.
Let's do a check of the market, sponsored by Tasty Trades. Seeing a little bit of a mixed bag here. You've got the Dow and the S&P, and the green, the S&P up nearly 0.2%. The Nasdaq looking a little bit flat here. Also seeing, when you look at the bond market, yields likely going to continue to keep declining today as we're starting to see a little bit of short covering in the market. I just want to take a quick look at what we're seeing in terms of the individual performers on the S&P 500 today. Looking like Disney is the second worst performer in the S&P today. We're also seeing that Nvidia and Tesla pulling down the S&P as well. So that might explain some of the negative action that we are seeing there in the stock market. Let's take a look at some trending tickers on Yahoo Finance. Instacart getting into the restaurant delivery business. In the upcoming weeks, users on the Instacart app will be able to order from local restaurants with the back-end mechanics being powered by Uber. This is a fascinating move for Instacart. It's up a little over 1% there, and we're seeing Uber flipping a little bit unchanged. But it's interesting because, Sean, I feel like Instacart has been coming up a lot on our show lately as we've been talking about some competition in the delivery space. Amazon, Walmart talking about additional products and services when it comes to food delivery. So this has got to be great news for their executive team as they start to kind of compete with the Uber Eats of the world and kind of merge with them in a way.
It does. And it's interesting when you take a look at that stock reaction right now. We have shares up just about 1%. Right after this was announced, we actually saw a pop of nearly 6 to 7% move higher. So we're off the highs of this announcement, but also flipping over and taking a look at what this means for some of that competition within the space, because DoorDash shares right now, they're off just about 2%. They were initially down about 7% on this news. Obviously, this putting Instacart in direct competition with DoorDash here, potentially further pressuring their business here to the downside. But why does this make sense? It was interesting within this release, Uber CEO Dara Khosrowshahi saying that our goal is to make it effortless for people to go anywhere to get anything. They're excited about this new strategic partnership with Instacart, and they think it's going to bring the magic of Uber Eats to even more consumers. So viewing this as a win-win, which is what you would think, obviously, when a partnership is reached between Instacart and Uber. But I think that further disruption within the space and what it will do to a name like DoorDash here to their business down the road is something that investors are obviously trying to figure out right now.
Especially when we know that DoorDash mentioned in their earnings that they're struggling with some of the policies regarding wages for their workers. It seems like they've been struggling already with their stock, and that's only going to continue off this news, Shauna.
All right, well, stock that has been struggling now for some time. Let's talk about a company. It's Peloton. It's actually moving to the upside here this morning, and here's why. There's a new CNBC report out saying that multiple PE firms are interested in buying out the home fitness company. Some of the discussions surrounding the buyout have centered around ways to cut operating costs at the company. You've got shares higher just about 12%. Now, the CNBC report didn't name any of the PE firms that are potentially interested in this deal, but you take a look at why this time. We have Peloton, who just reported earnings late last week. They're talking about uncertain revenue prospects at this time, weakening demand. You could talk about maybe market saturation at some point here within this industry, what exactly that growth rate realistically looks like going forward, and what is going to be that catalyst here for the stock if it were to remain a standalone company. So I think given the pressure that Peloton has been under, given the fact that we're going to be having a new CEO too at the helm, a report like this, especially the one out here from CNBC, not exactly a huge surprise.
Not a huge surprise, and I should mention, just in terms of the context for the stock, they're down over 31% year to date. Today's gains making the highest since April. So interesting to see that they're kind of clawing back, but still very much so in negative territory. After their last earnings print, Bank of America reiterating an underperform on the stock on low subscriber growth. Fourth quarter revenue guidance lowered. EBITDA was raised there, but the PE interest sort of making sense after that. Again, as you mentioned, Shauna, the CEO ouster, the churn that we're seeing with Peloton. Every time I go on Facebook Marketplace, I see a new Peloton for sale for $100. You don't like to hear that if you're the CEO.
I love my Peloton.
People
are selling them for $100? Yes.
We got to talk because every day I message someone and then I never follow through. All right, we're going to move on here because UBS shares jumping this morning after the Swiss bank surprised investors with a $1.8 billion profit in the first quarter, easing concerns about Swiss plans to raise capital requirements there. And it's really interesting, Shauna, because obviously there's been a huge story when it comes to UBS struggling here. So seeing this kind of shift in their profitability here, a huge deal for them, up over 8% off of that news, and just continuing to see that this story for UBS keeps shifting over time. Obviously, such issues for them and the Swiss National Bank as well. starting to kind of come around.
Yeah, exactly. And that's why we're seeing a huge pop in the stock here this morning, up just about 8%. If we do go back to the intraday high, what we were at earlier in trading, it had been up just about 10%. We'll actually see the biggest gain here for UBS in over a year. So it alleviated some of those concerns that you were talking about, just plans here to raise capital requirements. Then when you talk about the fact that it's sticking with the share buybacks, the fact that its profit stunned investors, I think it's fair to say, when you talk about $1.8 billion in first quarter profit, really put some of those concerns to rest, at least for now, and we're seeing a pop in shares today.
Absolutely. Well, another pop that we're seeing, Bitcoin hovering around $63,000 today as volatility for the asset escalating as investors question when the Fed will begin cutting rates. We're actually seeing a move to the downside in Bitcoin here, but it's still up over 40% so far year to date. Joining us to discuss, we have Anthony Pompliano, Pump Investments founder. Anthony, thanks for being in studio with us.
Absolutely. Thanks so much for having me, guys.
So we are seeing obviously a lot of volatility around Bitcoin, but still at 200-day moving average highs. What does it tell you about the momentum for Bitcoin moving forward?
Yeah, I think that a lot of people get distracted by the day-to-day price, right? It's a volatile asset, but really the volatility of it is the US dollar exchange price. So it's how many dollars are people willing to depart with in order to get a Bitcoin. But what we have continued to see over the long run is that Bitcoin is probably the most desirable asset in the world. And so people around the world continue to buy this thing, and that's why you're seeing that 200-day moving average, right? Kind of these longer-term trends continue to go up. And now with the ETFs getting approved, you not only have retail investors, family offices, a couple of corporations. Now it's coming out that some of the largest RIAs, Hightower just came out and said they bought some Bitcoin. There's sovereign wealth funds, many others that are all trying to buy this thing. So I think that it's a really, really good long-term tailwind at its back.
So you talk about the fact it's a great long-term tailwind. Then where does the price go from here? I mean, we're waiting for maybe that future catalyst. Then what is the next thing that's on the horizon?
Well, the Federal Reserve is the greatest Bitcoin proponent possible, right? Because they're going to continue to debase the dollar. And so if you watch that same thing like real estate, right? Real estate in certain markets can go up or down in a month-to-month or year-to-year basis. And so if you're kind of short-term oriented, you're likely to maybe mess up. But if you buy real estate and you hold it for 20 years, very few places in the world have you not seen that real estate go up in value. Same thing with Bitcoin, right? It's got these sound money principles. It's outside the system. No one can create more of it. And it's priced in dollars today. And so if all of a sudden the dollar is losing value and there's only 21 million Bitcoin, somebody is going to have to pay you more dollars in the future to buy that same Bitcoin. And so I think that it really incentivizes long-term thinking. And so the people who are short-term oriented or trying to trade, it's an 80 vol asset, right? I mean, good luck. And so buying it, just holding it and waiting is probably one of the best strategies.
Well, I want to talk about the Bitcoin ETFs and some of the outflows and inflows that we're seeing. Obviously, record-breaking outflows for Grayscale to the tune of almost $17.5 billion. But I know they did just recently have their very first week of inflows, so congrats to them. I wonder what story that tells you. Is that something idiosyncratic to Grayscale, or is that indicative of maybe more institutional money coming into the space?
Yeah, look, I think that they knew by not lowering their fee to be competitive with everybody else that people were going to leave. And the calculation was how many people are going to leave and what is it going to make up for in terms of this fee. Now, what's really interesting is their market cap of the AUM that they have is much higher than maybe everyone expected because the price of Bitcoin is up 50%. Right? And so all of a sudden you're seeing that fund continue to grow in size, and that's really blunted a lot of the pain of those capital outflows. Now, what I do think is interesting in terms of the inflows is you got to ask yourself, like, who's buying that, right? If there's these other ETFs available, it's unclear. And until we know who that is, you really can't kind of analyze it. But I do think it speaks to this larger story of like fees matter to a degree, but actually when you're looking at an asset that goes up hundreds of %, the difference between 50 basis points and 150 basis points, it's material, but really the decision is, did I allocate or did I not? That's going to ultimately drive most of the return that you're going to experience.
And give us just a better sense of that institutional involvement. Obviously, we saw a lot of excitement surrounding this, but exactly how this has played out and the fact that it needs to take some time, right, to follow through. So what does that timeline then look like?
Well, I think that you've already seen institutions allocating, right? And so obviously having BlackRock and Fidelity, and I always joke that like Larry Fink is now the CMO of Bitcoin. He goes on TV and talks about a flight to quality. That helps. It's very similar to in 2020 what we saw with Stanley Druckenmiller and Paul Tudor Jones coming out and saying, look, I bought Bitcoin. That reduced that career risk for other portfolio managers. And so now what I think you're starting to see is people who have already been doing work. They're like, okay, the ETFs are approved. I see Fidelity and BlackRock. This isn't like a sideshow. This is important to them. They're really going to go do this. Oh, I just heard Hightower's putting money into this. let's go do the work, right? And the work can be like, literally we're starting from scratch of like, what is Bitcoin, right? And like, how does it work? And let's go read the white paper and things like that. All the way to, hey, we've been trying to understand this for a while now. Now we got to go through our approval process. Let's go bring it to the investment committee. Let's go talk about it. And then even when you get the approval at the investment committee, you still, let's say you have financial advisors, they got to go talk to the clients. Right? And so you can imagine going and having the conversation. You may be starting that conversation with like, what is Bitcoin? Why is it important in a portfolio? Here's the research we've done. So there's a lot of work that happens. Now, if we look over the long period of time, call it 18 months, most of that work's going to get done. And so I don't think that it is ETFs get approved, $1 trillion flows in. But I do think that over the next 18 months or so, we're going to continue to see this persistent bid. Happens to line up with a bull market and obviously the halving that just occurred. And so it should push the price much higher.
Well, let's talk about the SEC, because Ethereum, this lawsuit accusing the SEC of considering it as a security, it was called a commodity. The founder now saying it was gaslighting from the SEC. What would you call it?
Yeah, look, America has this amazing kind of court system, right? And so I think that one of the things that the SEC has done a great job of throughout decades is when they think that somebody's doing something wrong, they usually go and they try to either negotiate a settlement or they go to court. And what we have seen time and time again is that the SEC historically has been on the right side of many of those cases. Mm-hmm. What has happened in crypto recently is a couple of people have said, well, wait a second, why don't we use the court system to go say, well, we think you're wrong. And the beautiful thing about America, not very many places around the world, but in America specifically, is that the SEC is going to send their best lawyers. The other groups are going to send their best lawyers. They're going to argue it out in court, and the judge or a jury is going to decide who's right and who's wrong. And so I think that I don't have a strong opinion as to like who is right or wrong. The facts are, if you read both briefings, they kind of have very different tale of what the facts are. But I do think that we've got to find some sort of solace in the fact that the court will decide this. Now, I always have told people in the crypto industry, like they want quote unquote regulatory clarity. Yeah. Just because you get clarity does not mean you get the answer you want. Right? And so, yes, you want clarity, but actually a lot of times when people say they want regulatory clarity is they're like, but we want it approved in the way that we want. Mm-hmm. And so I think that we will get the clarity. It's just people have got to be really careful here as to like, okay, if you get that clarity and it's not what you want, how are you going to change the way that you do it? And the last thing I would say is just like, if we don't get clarity in the way that I think the crypto industry wants, there is a very real brain drain. There are people who are leaving the United States, and so if we want to be the leader in this kind of innovative field, we're going to have to figure out how to do that, but also have these people operate within a set of rules.
How could the upcoming election impact that regulatory clarity?
Yeah, I think Trump has done kind of a 180. He historically, was very much like, I like the dollar, I don't like anything else. I think Vivek has kind of been in his ear a little bit about Bitcoin. I think at one point he was even on stage and he was like, basically like, Vivek just said it, I should say this out here. Kind of said, he was open to Bitcoin. It's unclear kind of what Biden's personal views are, but it seems like the administration is not as friendly to it. And so I do think that you're starting to see candidates, though, that show up, Vivek, RFK, et cetera, who are very pro-Bitcoin, pro-freedom technologies, et cetera. And regardless of maybe the like 70-plus crowd that is running for president today, it's a generational thing. And so what you're going to get is you're going to get people under the age of 40 or 50, like they're growing up with this, right? And so it's kind of like when our generation, there's people running for president, if they don't support the technologies that we grew up on, we're going to be like, you're an idiot, right? And so it's okay for the kind of the older generation because there's that generational gap. But I think just over the long run, old people die, young people replace them, young people grow up with these technologies. It's going to be kind of the standard.
How confident are you that we're going to get some clarity here?
Well, they have to get clarity at some point, right? Because basically what the crypto industry has done is they've basically pushed the issue, right? And they've just started launching things. They've started doing stuff. And so obviously if you're a regulatory body and you disagree with it, you don't like that. So you're going to bring enforcement actions. You're going to go try to drive clarity. Now, there's questions about should we be doing that through a legislative process or through an enforcement process? Again, that's for people much smarter than me to figure out. But I also think that what we are playing is a global game of competition as well, right? And so, an interesting data point is that the stablecoin issuers are now, I believe, one of the top 17 buyers of U.S. Treasuries. And so when you look at that, you say, okay, well, it used to be that China and Japan bought 22% of all U.S. Treasuries. Well, we got a pretty big federal debt, right? We're issuing a lot of debt, and so obviously we need people to buy that stuff. China and Japan went from 22%, now they're only 7%. So if they're going to stop buying, or at least buy less of these bonds, who is going to be the new buyer? Well, stablecoins have actually showed up. And so my prediction is that the stablecoin issuers collectively will end up being kind of top 10 U.S. Treasury buyers in the world. If that happens, all of a sudden that is systemically important. Right? We need these people to buy this debt. And so I think there's a lot of nuance and intricacies here that we've got to kind of figure out. And you can't just bring a hammer down on an industry, specifically if they're one of the biggest buyers of U.S. Treasuries, and it's a time where we're spending, like crazy people. And so it's how do you enforce rules, but also not kind of screw up the positive aspects. And I just hope that they get it right.
Well, it's really interesting, especially given the record-breaking auction that we have this week, which seems to happen every single time we've got these auctions. Anthony, thank you so much for joining us. That was Anthony Pompliano, Pomp Investments founder, joining us here in studio. Well, Apple unveiling its newest iPad models moments ago, coming on the report that the tech giant is working on its own AI chips for data centers. We're going to hear from one analyst about what he thinks about the stock moving forward after the break.
Apple is reportedly developing its own AI chips for its data centers. This is according to a report out from the Wall Street Journal. Now, in a project calling it ACDC, and it comes as the tech giant just unveiled its newest iPads. Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst, joining us now. Tom, lots to unpack today, but first let's start out with that report that we got from the Journal, just the interest here, a possibility that we're going to get Apple's AI chips. What exactly, how big of a catalyst do you see that being for the stock here?
Sure. So when you look at artificial intelligence, it's going to be incredibly expensive from an investment standpoint and then from an operating expense standpoint. So you're seeing companies across the board, Amazon and now Apple, that are trying to address those costs. So in my opinion, this is more about improving the costs for AI for Apple than it is necessarily a new product release leveraging artificial intelligence or things of that nature. So I think it's good news for Apple, but I don't know that I would necessarily buy the stock. I certainly wouldn't consider changing my hold rating on the news.
Tom, how much is it going to, when you talk about it improving the cost here, by how much?
Yeah, so I do think it can meaningfully improve the cost. One of my favorite data points from the March quarter was on the Amazon earnings call when they talked about Anthropic pointing out that large language models cost $1 billion to create today, and in the future could cost $10 billion to create. So I don't know that this is a $9 billion cost saver for Apple, but I do think that they can save, very significant in the millions of dollars to the extent that they employ these chips at the data centers to improve the efficacy or, to make it cheaper to leverage artificial intelligence for Apple.
Well, Tom, there's this question that you hinted at where there's sort of this appetite for product news from Apple more so than just kind of being defensive on their spending and efficiency here. So I want to ask you about this iPad announcement that we're just getting in. It's thinner, faster, has a new screen. How excited are you about that news?
Well, apparently management is excited because when they gave their outlook for sales in the June quarter, they indicated that they expected double-digit revenue growth for the iPad lineup. So I think that it's good news. The challenge for consumer electronics companies, including Apple, is that there was a huge pull forward in demand, similar to what you saw in the home category in the early stages of the pandemic. And you haven't seen normalized growth rates for a lot of these products, including tablets. I think it's good news, but I would also say it's already reflected in the stock, given that management had already indicated that they're projecting 10% plus revenue growth for iPads in the June quarter.
All right, Tom, I also want to get your take on another big headline coming out here this morning, and it's involving Apple. There was a report out from DigiTimes saying that Apple is considering a partnership with the U.S. EV maker. A lot of talk about whether or not that's going to be Rivian or the possibility here of it being Rivian. But just last week on Market Domination Overtime here on Yahoo Finance, you expressed some disappointment that Apple gave up its car plans. I want to play that for our viewers and then get your reaction to this news on the other side.
I want to get past the fact that they're not doing a car. So as a Tesla Model 3 owner, I see a million opportunities for Apple to do at least as well, if not better. And then are they truly going to move forward with robots? And are the robots going to be a consumer device? Are we going to have the robots in our homes? Or is it going to be also robots at the assembly plant, which is kind of what Tesla seems to be doing?
So if we do see Apple back in the EV game to some extent, is that a smart move? It sounds like you think so, and why?
Well, all right. So when we used to, think about what Apple might be doing with electronic vehicles before the notion that they were going to potentially make the car and everything, what we thought they were going to do was the self-driving feature. So perhaps Rivian or one of these other non-Tesla automakers, Apple may get involved and work on the self-driving technology as it pertains to the car. So it doesn't change my frustration as a Model 3 Tesla owner that Apple's not creating the Apple version of a EV, but it is, I guess, a small step in the right direction, show that they're not giving up on EVs entirely.
Okay, but real quickly, Tom, I'm curious about why Apple just mentioning AI and even having it come up earlier than ever in their earnings report, why that's not a more bullish signal for you, especially given that we have guests come on all the time saying that they just want to see Apple starting to become a major player in the AI race, that they're kind of viewing it as losing so far.
The way I think about it is in 2024, AI means a lot of revenue for NVIDIA. And then it also means a lot of revenue, but not as much revenue for Microsoft Azure, for AWS, for Google Cloud. For a company like Apple or any other, consumer electronics hardware company, AI is more of a future opportunity than it is a sales and profit mover in 2024. So I look forward to learning more about their future product lineup as it pertains to artificial intelligence and what that could mean for revenue years out from now, less so today.
All right, all about those product announcements, hopefully more than the iPad in the future. Tom, thank you so much for joining us. That was Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst. Well, one of the key themes we've been seeing this earnings season, of course, buybacks. To name a few, we have Alphabet, the big guy Apple, and BP announcing plans to repurchase shares this season. Yahoo Finance reporter Josh Schaefer is here with a closer look. Josh.
Yeah, Maddie, so you guys were just talking about Apple. Obviously, that's going to skew our data a little bit here as they had the largest share repurchase, announced the largest share repurchase program ever at over $100 billion, right? But then when you take a look at the data overall, we're hitting some pretty high numbers here, guys. So Deutsche Bank, the team there led by Binky Chadha, tracks this data. And when you take a look at share buybacks over the last 13 weeks, so at about a 3-month pace, we're at $383 billion. That would be the highest level since 2018, barely surpassing a level that we had in 2022. And when you take a look broadly at earnings season, we have about $262 billion worth of buybacks announced. And I think the important thing to highlight here that the team over at Deutsche Bank was also pointing out, $82 billion of that is coming from companies outside of Apple and Alphabet. So we talk a lot about the big buybacks from Apple and Alphabet. As I mentioned, it sort of skews that 3-month data that we're talking about here, but there are buybacks happening in other places. And really the key takeaway from that is maybe companies are coming into a better position, right? We've talked a lot about earnings picking up over the last couple quarters. Earnings pick up, you have more cash flow. What do you do with it? Usually you pay out a dividend, maybe you increase your CapEx, and then you buy back some stock. So it's sort of one of the other levers that we get to as companies get in a better position. So this is something that a lot of strategists were sort of looking for headed into this earnings season is, do we see a pickup in buybacks? And it seems like we're checking that box.
And is this a trend that is expected to continue? And then we can also get into the probability or the likelihood that this is then going to be a tailwind here, potentially, for stocks going forward.
Yes, it's definitely something that strategists have listed as a tailwind for stocks. And the reason that is, Shauna, is because if you think about it from sort of a supply and demand standpoint, right, and you get to this area where people are talking about positioning being stretched, sentiment being stretched, well, who's another person that can buy stocks? The company, right? The company can come in and buy stocks. And that was something that Bank of America actually pointed out in their weekly flows that they released earlier this morning. They said that clients were actually net negative on flows last week, but buybacks help support the market overall. So clients were pulling out money from equities, but when you talk about corporate clients are coming in and buying their own stock back. That helps sort of support your market. So again, when you get to this high level of we're near record highs, you sort of already have people well positioned, feeling comfortable where they are, sentiment is high. Another lever that sort of pushes potentially the index higher could be buybacks, and that's why someone like Binky is sitting on, a 5,400 target or 5,500 target for their bull case right now for the S&P, things like buybacks.
All right, Josh, thank you so much as always. Really appreciate you bringing us that news. Well, stocks are extending their recent move higher. The S&P 500 on track for its best 3-day run of the year after Friday's Goldilocks jobs report put a possible rate cut back on the table. Now, earlier this morning, Minneapolis Fed President Neel Kashkari writing in an essay that progress on disinflation is stalling. This comes ahead of his speech later today. So for more on the Fed's path forward, we are joined in studio by Elise Osbaugh, Global Investment Strategist at JP Morgan Private Bank. Elise, thank you so much for being here in person. We really appreciate it. I know that we just got this Neel Kashkari essay out, but as we were talking about before, he talked about the housing inflation elephant in the room. And I'm curious, if we know that 95% of homeowners are locked into these 30-year fixed mortgage rates, at what point does a higher for longer environment start to become inflationary because it's keeping people in their houses for longer?
Look, especially as it relates to that shelter component of inflation, this is something that we have been kicking around and kind of debating. But when you look at the higher frequency data, specifically as it relates to rentals, it's still suggesting that you should see that formal shelter component continue to come down. I think even or as importantly is what's going on in the labor market, where you've still got this really robust foundation, but things like quits rates are coming down, that ratio of job openings to unemployed people is coming down, and it should alleviate some of the pressure on corporates to continue passing higher wage costs on to end consumers. And so those are the levers that we're expecting to really help us get over this final hump of inflation that ultimately will give the Fed confidence that they need to start cutting interest rates probably in the fourth quarter of this year.
So Elise, given those expectations, when we talk about the likely trading activity that we're going to see between now and year end, how do you see that playing out?
Well, I think last week was a perfect example of the fact that the Fed still does kind of seem to be in the driver's seat when it comes to investor sentiment. You mentioned that we're coming off of the best 3-day rally in the S&P 500 that we've seen since November, and that happened only once the market repriced the probability of 1, maybe 2 rate cuts coming later this year. So it does seem like some sort of condition, but even that aside, we're encouraged by the fact that, especially for the S&P 500, those companies still look really well capitalized. They've got strong interest coverage ratios, but something investors need to watch is a potential metastasis of this credit stress, because when you look at smaller and medium-sized companies, their interest coverage ratios are lower than they were before the pandemic, and so that could potentially be kind of the next pocket that starts to feel that pinch of higher rates.
When could that risk start to come to fruition, and what would be the indication that that's starting to happen?
I think you've got to continue to look at things like hiring plans, especially amongst those small companies, given that they employ about 75% of the labor force, but also just listening to things like corporate earnings calls, even beyond the S&P 500, for indication on how those executives might be feeling about future plans. But otherwise, we are watching every single data print, all of the inflation data, to continue to monitor and kind of recheck the outlook that we've put forward that the Fed will cut interest rates one time by year end.
Elise, let's talk about what we were just speaking with Josh about just a few moments ago, when we were talking about the large buybacks, the momentum that we've seen there. Talk to us just about the support that you think maybe this is potentially providing to the market and how big of a tailwind this could be for stocks.
Sure. So in the U.S., agree with everything Josh said about this offering kind of a nice foundation for investors. I think another thing we've really been encouraged by is simply the amount of capital expenditure plans that some of these companies in the S&P 500 are really putting forward. That's going to continue to power these trends that have offered a lot of support for the market, like AI, and we're looking for that trade to really start broadening out beyond these initial enablers. But even outside of the United States, right, it's notable to kind of observe that even European companies are, starting to engage in buyback activity, which is creating these, total cash yields in addition to the high dividends that you get in Europe that offer a really compelling kind of foundation for total returns for investors. So definitely a market worth looking at, especially as the macro backdrop starts to improve in that region as well.
When it comes to earnings, one thing I'm curious about is that we're starting to see EPS coming in above revenue. And it makes me wonder if we're seeing companies that are really good at efficiency, getting good at cutting costs, more so than a growth story. To what extent is that something that you're concerned about for market upside?
Sure. So I think it's a good thing that profit margins are improving versus last quarter. And we should be encouraged by the fact, especially in this environment where everyone's concerned about sticky inflation, that I think these companies learned how to manage those costs and navigate a world of inflation that's maybe running between 3 to 4% because they had to deal with it when it was pushing 10. As for the underlying demand, I continue to be really encouraged about the backdrop there. Thinking back to the GDP report that we got for the first quarter of the year, that headline, I think, obfuscated the dynamics that were going on underneath the surface, which is a picture of domestic demand that remains really robust when you look at that measure of final purchases to private domestic purchasers, still running at a steady and strong level.
And you like tech, healthcare, consumer discretionary. Can you tell me what the biggest momentum factors might be for those in our final minute with you?
Sure. So as far as the consumer is concerned, obviously the backbone of the U.S. economy, but we really think that the positive real wage growth dynamic is going to continue to support ongoing consumer spending. And that's one of the sectors that's entering, the strong phase of this rolling earnings recovery that we've been observing. And then for tech, it's really about that AI trade. That, I think, is going to continue to kind of be the biggest tailwind. We are absolutely believers in it. And as I mentioned before, we think that the strength is going to continue to broaden out beyond just those initial enablers.
Elise, thank you so much. Thanks for joining us in studio. We really appreciate it. That was Elise Ozenbaugh, Global Investment Strategist at JP Morgan Private Bank. Well, coming up, Datadog shares sinking on the back of a leadership shakeup. We're going to get some more trending tickers on the other side of this break. This is Yahoo Finance. Shares of Datadog sinking this morning, down over 10% after announcing a leadership transition. The company's president stepping down at the end of 2024. But Datadog did still see first quarter revenue jumping 27% from a year ago. And after initial look at the notes coming out after this, Shauna, it's looking like there's this sentiment that maybe that executive move might be overshadowing some pretty good news. There's not a ton to be angry about in this print. I want to take a look at what Barclays is saying. They're overweight on Datadog, the price target of 152, saying the quarter was healthy, showed further reacceleration of revenue growth, and it was just a good expectation setting quarter overall. Bernstein also adding that they did not have as much market share taken from AWS as they had anticipated. So two of the voices kind of expressing some positive sentiment on the name, while we're seeing that executive change sort of overly weighing on the stock a little bit.
Yeah, exactly. And I think the big takeaway here, at least from the street initially, was largely that this print is viewed as positive. Yes, there are some reasons to take issue with some of these numbers, specifically that solid revenue growth that you were just talking about coming in slightly below some buy-side expectations. But again, when you take a look at some of the analyst reaction that you were just referencing, pairing that with also Barclays out saying that the quarter was healthy, it also showed further reacceleration of that revenue growth here. That's why we're seeing the stock among one of the top trending tickers here on Yahoo Finance. But again, those shares, despite all that, still moving to the downside here in early trading. All right, another stock that's on our radar is Crocs. You got shares moving to the upside, up just about nearly 10%. The company beating the street's revenue expectations, also raising its full year guidance. Demand remaining strong for its clogs. The company, though, did warn the sales for its casual footwear brand Hey Dude, which had been a hit and really helped the stock in previous quarters here. We've seen some of slippage there, and that is expected to be pressured throughout the remainder of the year. But again, the focus here on those beats that we're getting here from Crocs, and again, shares popping to the upside here, Maddie.
Yeah, they also announced a management change as well in a statement saying that their CFO is going to have a change. Susan Healy as Executive Vice President and Chief Financial Officer is going to be that change here. That's the appointment of Susan into that role. The current CFO is going to remain in position until June 3rd when Susan is going to be starting in that role. So an executive change. But looking at this stock, again, not a ton to be mad about. It's up 36% year to date. That was heading into this print, and now they're up a little over 9% after that print as well.
All right, well, earnings on tap this week will give us a better idea of how consumers are spending. For the first quarter of the year, consumer spending had accounted for nearly 68% of the U.S. GDP, according to the U.S. Bureau of Economic Analysis, and small businesses generally accounting for nearly 44% of economic activity. This is according to the Small Business Administration. Well, as part of Yahoo Finance's Small Business Big Opportunities Week, we are going to explore how investors can cash into the big businesses that are supporting those smaller businesses. For that, we've got a panel for you. We've got Nick Jones, Citizens JMP Equity Research Analyst. And we also have Marvin Fong here at the desk, BTIG Director, both here with us. Nick, let me start with you. When we talk about small businesses and really what this means for investors out there, maybe trying to get a piece or trying to cash in on some of that momentum that we are seeing, you cover Etsy. Clearly very exposed to the small business. What are you seeing in terms of the trends there? Is it still a pillar of strength for the company?
Yeah, I mean, Etsy's always been able to grow its seller base. In fact, they've even put initiatives in place to maybe slow the seller growth to make sure they have high quality sellers. So when I look at Etsy, it is a pillar for small businesses, particularly if they don't have the skill set to launch a Shopify account or a Wix website and manage all the digital advertising by themselves, whether it's on Google, Meta, Facebook and Instagram. So we think, I still view it very much as a kind of a pillar of small businesses, particularly for those who want to work from home and sell things that they're good at making.
Well, Marvin, I know that you cover Etsy, you also cover Fiverr. So I'm curious, what are some of those, I guess I could call them like gig economy adjacent names, telling you about the state of the consumer, specifically through the lens of a small business operator? What are you learning from that?
Thanks for having me. Yeah, Etsy is calling out, along with a lot of other firms, Starbucks, McDonald's, even CEO of Citibank, calling out that the low-income household continues to struggle, burdened by inflation, cost of necessities are going up. Another headwind as far as merchandise goes is that people continue to want to spend on experiences, travel, et cetera. So, what we're seeing with the lower-income household is clearly that that's been a drag for Etsy. It's actually, they're calling out that it's not only the sub $50,000 household income households that are struggling, but even the $50,000 to $100,000 households are seeing some pressure. Where they're actually seeing some strength, continued strength, is in the $200,000 plus income households. So there is a kind of a separation in the economy there. And then with companies like Fiverr and Upwork that I cover that are tied to the freelancing economy, you do see that when times are tough, people want to start doing their own side hustles. It could be something simple like driving for Uber or Lyft. These platforms tend to specialize more in kind of white collar work, but they're seeing plenty of supply. And then you have small businesses that continue to need to adapt to the times. They need tech help. They need customer service help, things like that. This can be an affordable way for them to access that kind of talent without taking on full-time labor.
So we have Etsy, we have Fiverr, and then you also cover eBay, which also caters to the space to a certain extent. I'm curious just what your top plays are within that sector, given the consumer exposure, and why.
Yeah, right now it is very difficult. The consumer challenge, particularly the lower income consumer. Across the board, even at Amazon, we're hearing people are being more discerning, looking for discounts. So, when we look at eBay, it's potentially a little more interesting, although we still are neutral on that one as well. They have exposure to kind of secondhand clothes, secondhand handbags, things like that are a little more affordable for folks who are still looking for things like that. But overall, we still view eBay for small businesses as a really powerful platform for them to get exposure, whether it's in auto parts, whether it's in handbags, whether it's in trading cards, including Pokemon cards, things like that. So really interesting platform, but kind of broadly we're hearing consumer pressures, and we're seeing it show up with kind of the likes of Temu and Shein. People looking for really steep discounts. They're showing up with kind of fast fashion and cheap technology that a lot of these SMBs can't really compete with.
That is exactly what I was going to ask next. I remember on the Amazon media call, I asked about the competition of Temu and Shein, and I wonder whether or not that's starting to weigh on some of the Etsy sellers. Maybe people are just, searching for a dupe image and seeing an expensive product show up on Temu and buying that instead of buying it from an Etsy seller.
It's come up a lot in the past several Etsy calls. What kind of pressure are you seeing from these guys? Clearly, when you're shopping on Etsy, you're typically looking for kind of a one-of-a-kind item, something that's not your everyday mass-produced item. Having said that, there's going to be some portion of the population that's just going to be drawn to that 90% or whatever discount. So, it is interesting. We've looked hard at the traffic data. There is, about 20% of, people that visit Etsy on the same day will visit Temu or something like that. So, it's a pretty good overlap, but you got to recognize that Etsy is drawing hundreds of millions of visitors every month. So it doesn't necessarily mean that they're overly exposed to that. These are just people who are shopping on Etsy every month anyway, so they're going to get some level of overlap. Same thing with Amazon. There's about 85% overlap, but Amazon's getting 80 to 85% of the traffic month in, month out. So you'd expect a very high level of overlap. Management of Etsy talked about last quarter. They actually think where they're seeing more pressure is from people that are like consolidating their trips. You're going to Walmart, you're going to Target, you want to just buy everything there, and so you're going to pick up that little gift for your nephew and not going to go buy it on Etsy. They think that that's actually a bigger headwind to their growth than the competition from Temu and Shein.
That would make a lot of sense. All right, well, Marvin Fong, Nick Jones, thank you both so much for joining us here in studio for this discussion. All right, let's do a final check of the markets 90 minutes into the trading day. You're still looking at gains across the board. You've got the Dow up just over 100 points. When you take a look at the sector action, outperformance coming from utilities and real estate, top performing sectors so far in early trading.
Well, coming up, wealth dedicated to all of your personal finance needs is around the corner. Brad Smith is going to have you for the next hour, and he'll do a deeper dive into what those Disney results signal about the consumer. Stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, Social Security funding. A new projection reveals when funding might run out. We're going to talk with an expert with the key date that you need to know and what it means for your retirement. Plus, housing hurdles. Fewer renters than ever believe they will ever be able to afford a home, according to a new survey. We've got the details there. Plus, the experience economy. People are spending more than ever on trips and vacations. We give you the tips and tricks that you need to ball on a budget. Well, before then, Disney is out with earnings ahead of the open. The company's direct-to-consumer platforms, Disney Plus and Hulu, reached profitability for the first time ever. Does that mean that you might have to stop sharing your password with family and friends here because of some new crackdowns that could be on the way? Our own Alexandra Canal has more. Hey, Allie.
Hey, Brad. Unfortunately, it looks like that's the case. If you're a subscriber to Disney Plus, Hulu, or ESPN Plus, that password sharing crackdown is coming for your accounts. The company did confirm on the earnings call that a rollout on that crackdown is expected next month in select markets. We are going to see a wider global rollout start in September. And this comes as Disney is really looking to achieve sustained profitability. It was interesting on the earnings call, Bob Iger did reference Netflix, which is arguably its biggest streaming competitor, saying that they have done a great job with the password sharing crackdown. And you can see that in the results, as Netflix has been the only consistently profitable streaming service on the market. He said in part, quote, "We feel quite bullish about it. Obviously, we're heartened by the results that Netflix has delivered in their password sharing initiative and believe that it will be one of the contributors to growth." And that comes as, really right now we're seeing streaming hurdles across the board here. Yes, we did see Disney Plus and Hulu turn a profit for the first time ever in the quarter, but the company did warn that that's going to dip again in Q3. Overall, total direct-to-consumer losses, that is still it. We still have a loss here. We're not profitable there quite yet. Iger thinks that this password sharing crackdown can help us get there.
And then what about on the experiences side of this business? I mean, what are we picking up there about how the pricing may shift when we're going to the Magic Kingdom and perhaps it feels a little bit less magical because of how much we have to spend?
Right. Well, the company did note that inflation is pressuring its bottom line, especially when you think of those higher cruise ship costs, higher costs in the parks business overall, and that they're noticing a waning of demand when it comes to that peak COVID, post-COVID travel that we saw with a lot of consumers, right? Yeah. Many people were locked in their homes. They wanted to get out there. Now Disney is saying that's not necessarily the case anymore. We're seeing a bit of a pullback there, and that comes as prices have risen really across the board. So this is a very important narrative to really watch for a company like Disney, since consumers drive the bulk of their business. If they're not spending on the cruise lines, if they're not spending on the parks, and they're not attending, that's going to hit demand. So all things to start watching.
And the incremental purchases, if they're not paying up to skip the lines as well.
Exactly. Got to get those fast pass lines.
Exactly. Allie, thanks so much for taking the time breaking down all things House of Mouse. Well, continuing the conversation here on Disney shares falling on those mixed Q2 results. So how should you consider making investment decisions after this report? Joining me now, we've got Geeta Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Great to have you here with us, Geeta. First and foremost, just want to get your read in on this report and how investors seem to be reacting to this as we're seeing shares slip here out of the gate this morning as we're about 90 minutes into trade.
Yeah, thank you, Brad. So the fiscal 2Q results itself, I think, were pretty good. There was obviously an earnings beat, as you pointed out. Streaming for the very first time in its history turned profitable, and that really kind of sets the stage for the future of this streaming business. It is going to churn out a lot in profits, upwards of 1.5 billion probably in fiscal 2025. And ultimately, look at where Netflix is today. This year they are estimated to throw out about $10 billion in profit. And so, we kind of see the same path for Disney also. But I think what is really spooking investors today is their commentary on the parks business. So they, as Ali just pointed out, they did say that they are seeing this moderation in demand. And for the fiscal third quarter, their guidance was really, really choppy. They basically said, expect absolutely no growth in theme park operating income. Consensus had that at about 12%. So that's where you're seeing a lot of that nervousness kind of come in this morning.
At what point are we going to have to start seeing companies cut the prices here? I mean, for the theme park pricing, it's gotten really expensive. And even as you're thinking about taking an entire family there, that runs up the tab real quick when you're talking about concessions on top of that. And oh yeah, I got to get the merchandise because the kid wants the doll. So all of these things considered, how does that impact the pricing mechanisms that these companies are talking about?
It, for certain, Brad, I mean, it is going to lower their pricing power, right? They have, it's a very, very tricky balancing act between, raising prices and balancing a good, strong, healthy, robust demand. Right, coming out after COVID, we saw almost a 40% increase in per capita spending across the parks. We saw huge profit numbers. We saw huge attendance numbers. Of course, we're going to see a big moderation in all of that. But you're absolutely right in terms of them. Their future strategy obviously has to be this very, very careful mix and this very careful kind of balancing act when it comes to taking pricing increases.
We talked about streaming as well here, and of course the milestone that they did see on that front here. Do you think that's sustainable?
It absolutely is sustainable. And for Disney, they have plenty of levers, right? They have this integration with Hulu that is coming up. Just yesterday, we got some news about them kind of pulling in a third-party arbitrator to determine the value there. And hopefully that should get resolved in the course of the next few months. And once that does get resolved, they basically pay the rest of the money to Comcast, and the asset is fully integrated. That should help them realize some good operating income synergies, especially when they kind of combine that with the Disney Plus business. They can take out a lot of extraneous costs. And then, of course, you have the advertising tier, right? Disney Plus just introduced advertising. They haven't necessarily broken out any numbers, but obviously as more and more eyeballs kind of keep shifting to streaming in general, connected TV advertising is really gaining steam, and we expect Disney Plus to benefit. And of course, the big one, as both you and Ali just pointed out, is that crackdown on password sharing. I mean, after Netflix, that's just been a home run for Netflix. So after they implemented that sometime last year, we know that Netflix gained around 35 million subscribers. So obviously it's a huge subscriber growth driver. It's a huge ARPU driver in the long run. And so we definitely think that Disney will benefit from that as well.
You mentioned Netflix, and somewhat of a long-winded question here, I guess, but of course Disney just coming off of that activist board seat battle here with Tryon, and ultimately they were able to retain that board seat, but that activist campaign actually put investors on notice for the type of margins that they should want to see Disney be able to achieve, and that comps them up to Netflix. So is Disney going to be able to get to that type of margin profile on the streaming business?
So what they have said right now, Brad, is they haven't actually given us an exact margin number. They have, though, guided to double-digit margins. Now, just for context here, Netflix this year will report 25% operating margin. And this has kind of been the perennial question, Brad, in media. If you kind of looked at the old cable TV business, that was about a 35% margin business. And as everybody kind of made this transition to streaming, the question was, are we ever going to be profitable? Of course, Netflix has kind of paved the way there. I think with Netflix itself, we'll kind of see them get to 35% margins. And with Disney too, I think obviously they're not going to get there as quickly as Netflix, but they obviously have set kind of that playbook. And I think Disney will get there too in due course. They do have a lot of operating leverage in their model as well.
Geeta Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Geeta, great to see you, and thanks so much for taking the time.
Thank you, Brad. Thanks for having me.
Certainly. Everyone, up next on Wealth. Social Security getting a little bit of a lifeline, but fundamentally the program faces a funding crisis still. What it means for your path to retirement. It's coming up next. Let's do a check of the markets sponsored by Tasty Trade. The Dow, the S&P 500, and the Nasdaq are all in positive territory, all of them higher by about 0.2% or more. The Dow right now is up by about 0.3%, 107 points to the upside there. The S&P 500 up by about 15 points, 0.3% roughly to the upside there as well. Well, Social Security is expected to run short on funds in 2035. That's 1 year later than previously forecast, thanks to stronger economic growth. That's from the Social Security Board of Trustees annual report. To break down the report for us, we've got Andrew Biggs, who is the senior fellow at the American Enterprise Institute. Andrew, thanks so much for joining us here today. First and foremost, all right, we pushed back by about 1 year. What's the significance of that, and could we potentially see that line move a little bit more?
Well, thanks for having me today, Brad. I'm happy to be with you. Yeah, we've seen a 1 year delay in the projected insolvency date of the Social Security trust funds. Last year, the trustees thought the funds would run out in 2034. Now they're saying it'd be 2035. So it's been a slight improvement in the system's finances. But still, in 2035, if nothing else is done, benefits would have to be cut across the board by 17%. So this is still a pressing problem with the federal government's largest spending program.
What are the factors that contributed most to moving that kind of, and to contributing to that 1 year delta that we've seen now between 2034 and 2035, the new date here?
Well, people are familiar with the forces driving Social Security. The trustees project going forward, the aging of the population, of how many retirees we'll have, how the economy will grow. What really happened here was the starting point improved. The economy grew a bit faster over the past year or so than the trustees had previously projected. So you're starting out that projection in a better situation than you were before. So the underlying factors of demographics and population aging haven't changed, but we're in a little better situation today because the economy and employment and wages have been good over the past year or so.
How do people need to change the savings that they're doing for retirement as well? We were speaking with Apollo Global CEO Mark Rowan yesterday at Milken, and one of the things that he said, it's not just worldwide. Everyone in the Western world, we have aging population, as you mentioned, government's doing less, you mentioned that, and an era of low interest rates, and for the most part, people have not saved appropriately for retirement. How can we change that and the thinking around saving for retirement?
Well, I'm actually somebody who's very bullish on retirement savings in the U.S. If you actually look at the data from the Federal Reserve and elsewhere, retirement savings are at record levels. More Americans are participating in 401ks. They're contributing more to them. So I think the retirement savings part on the household end has actually been pretty healthy. The real issue is what's going to happen with Social Security. For 40 years, the government has known the system faced a gap, and they haven't done anything about it. If I were somebody saving for retirement, and I am, I would save a little bit more today because you don't know exactly how the government is going to resolve that funding gap 10 years from now.
That's a great point. At what kind of comparison do you see people tapping into even employer-sponsored retirement programs as well at this juncture?
Well, if you look at Bureau of Labor Statistics data, 70% of private sector workers today are offered a retirement plan on the job. If you go back to the 1970s, when traditional defined benefit pensions were at their peak, only 39% of private sector workers were offered a plan. So we do have better coverage today. We have more automatic enrollment in 401ks. People are paying more out of their paychecks. So retiree incomes today are at record levels. Poverty and old age has come down significantly. So really, I think that the private side of the retirement savings story is a really an unrecognized success story, but we still have to get on top of Social Security. And that's a political challenge, not so much as a financial or retirement planning one.
How might the general election this year impact that as well, given the political challenge you mentioned?
Well, on paper, President Biden and former President Trump have the same position on Social Security. Both oppose any cuts. Now, that's a change because President Trump is a Republican. Republicans, like George W. Bush, have generally favored fixing Social Security by reducing benefits over time. So both presidential candidates have the same position on benefits. The problem is neither of them have proposed the tax increases necessary to keep those promises. So we're in a very united situation today with our two presidential contenders, but both of them are falling short on the specifics needed to actually keep Social Security solvent.
Andrew Biggs, American Enterprise Institute Senior Fellow. Thanks so much for taking the time, Andrew.
Hey, my pleasure.
Certainly. A fresh read on the housing sector as well today. A Federal Reserve Bank of New York survey shows that Americans are once again bracing for another round of higher housing costs. Yahoo Finance's Danny Romero is all over this one and has more on consumers' view about the housing market. Hey, Danny.
Good morning, Brad. High housing costs, rising mortgage rates is standing in the way of the American dream of obtaining a home. And this survey from the New York Federal Reserve really shows that the share of renters that believe that someday they will own a home plummeted. It hit a record low at 13.4% this year in February. That's down from 15% last year. Now, this survey, remember, focuses on housing and the broader consumer expectation. And one of the key points to highlight from this survey is that 74% of consumers that view getting a mortgage rate is very difficult, and that substantially deteriorated from last year's expectations, which was around 66% of consumers were thinking that way. Now, one of the factors to blame, of course, is mortgage rates. They're above 7%, which is really sidelining a lot of consumers right now, and including myself. The other point to highlight from this survey is that consumers expect that mortgage rates could rise to 8.7% in the next 3 years. It's a really sour sentiment right there. But 61% though do expect that rates could cut in the next 12 months. But another factor to all of this equation in the housing market is, of course, home prices, and those have been increasing, and consumers expect that that will increase to 5.1% over the next year, and that's up about 2.6% from last year's survey. Now, again, one of the expectations, again, is rent prices will increase. So if more people are staying in the rental market, they think those prices will also go up. But if we take a look at current rent data right now, rent prices have increased slowly due to the fact that there has been more supply added to the market. But again, Brad, this survey really does highlight where consumers are thinking about the current housing market, and it doesn't look so good.
All right, Danny, great evaluation of the data here. Yahoo Finance's own Danny Romero, appreciate it. Everyone, we've got much more on wealth after the break. Stay tuned. You're watching Yahoo Finance. The entertainment economy is alive and thriving, and we're seeing it pay off for companies like Vivid Seats. The ticketing giant reporting revenue in the first quarter rose 18%, bolstered by ticket buying for live events. Zooming in on some key metrics here. Marketplace gross order value, which represents the total transaction amount on the platform, that's up 20% from the year prior. And total marketplace orders, the number of orders placed is up 26% year over year. Here with more, we've got Stan Chia, who is the CEO of Vivid Seats. Stan, always a pleasure to grab some time with you here. Got to walk through some of the highlights for the quarter here and what you're seeing more broadly here within the entertainment and experience economy right now hold up strong.
Yeah, of course. Good morning. Thank you for having me on the show. Look, I think great quarter for the company. We remain really excited, as you mentioned, 20% GOV growth on a year-over-year basis, doing, for sequentially over $1 billion in GOV this quarter. And on the backs of that, delivering $39 million in adjusted EBITDA, over a 20% beat to where the street had us. So I think just great performance. And as you look at a lot of the investments that we've made underpinning that, a great loyalty program driving repeat rates for consumers, I think great customer service, best customer service is recognized by Newsweek, engagement platforms and Game Center. And also, I think we're now in the fifth month of our acquisition of Vegas.com, the leading domain authority in Las Vegas, and lots of tailwinds there, whether it was the Super Bowl in the first quarter or upcoming concerts, tournaments, everything that you see there. I think we're really excited about the prospects for the industry and certainly our ability to participate and drive value for fans as well.
Certainly. Stan, there's a lot of focus right now among consumers who are going on any platform and shopping for tickets and just getting mind blown here by some of the fees that are charged on top of it. There's more fee transparency right now, sure, but what is really getting baked into some of these fees that people are paying on top of the ticket price?
Yeah, look, I think it's a great question. And look, what I can talk about from our perspective is we look at those fees as the ability for us to really take back and invest into value for consumers. You look at this last quarter that, what we reported, look, our take rate was 15.6%. If you just start with our loyalty program, right, we've got a buy 10, get one free, or effectively a 10% return to users who are members of the program, right, to then earn subsequent rewards and real currency that they can deploy towards future currency. So out of the gate, when you look at Vivid Seats, we're already reinvesting more than half the fee back into rewards that are tangibly used for consumers. And then we continue to invest, I think the revenue that comes in from that into things like best customer service, the ability to build great products like Game Center, Vivid Picks, Skybox, things that allow, again, constituents in the ecosystem to engage with us, drive value, earn free tickets, and have the confidence in a safe and trustworthy buying experience.
So after those investments are made in the platform, is there any point at which you believe that more broadly, kind of across the industry, we should see a receding in some of the added fee prices?
Look, I can't speak for anybody other than us. I think what we continue to do is try to make sure that, we drive a very transparent process for all consumers and that we are committed to certainly reinvesting the vast majority of those fees back into really value-added components for fans around the world.
Stan, I was flabbergasted to learn this morning in our morning meeting that Taylor Swift is still on tour. Still out there, still traveling the world, and is apparently coming back to the U.S., at least one of our chief Taylor correspondents told us this morning. So all of that considered, how much more additive could Taylor Swift provide to the experience economy, even going into and through this summer?
Yeah. Look, I think, what that speaks to is just the underlying strength of the overall category. I think we've been long bullish on the thesis that in live events, you've got this amazing intersection of demand and supply, right? Where we've seen fans continue to prioritize, this category over other discretionary income categories. And similarly, on the supply side, whether it's the sports teams, whether it's the artists, I think, looking to go out on tour as a big income generator and engaging with fans where they want to be engaged. I think those are both great trends that we remain just as bullish as ever will carry us through in the years to come.
Stan Chia, CEO of Vivid Seats. Stan, thanks so much for taking the time as always.
Thanks for having me this morning.
Certainly. Well, as we take a deeper dive into the experience economy, Yahoo Finance contributor Ross Mack is here with some tips on how you can save for your summer trip. Hey, Ross.
Brad, what's up, baby? How you doing?
I'm doing well. I'm trying to figure out how to ball on a budget on this next trip that I take.
Hey, you and me both. I'm going on vacay Thursday, and it's already trying to break the bank. I'm bringing the kids.
Excellent. So, all right, we're trying to figure out some successful ways that people can set up a proper vacation fund that allows them to plan adequately ahead of and then through a vacation as well. What tips you got?
Listen, man, when it comes to a vacation fund, everybody obviously wants to go on vacation, right? You want to post your pictures on the beach, you want to go viral, etc. But to what end, right? Are we going in debt trying to do that? And I think when it's all said and done, it's very prudent for you to set up a vacation fund. And what is that, right? I want you to start putting intervals of investments into a separate account so that once that vacation comes, guess what? You're not going into debt, right? And so when it's all said and done, maybe set up another account, right? Maybe a high yield account, which I always love because you're getting a great return on your money. But now the best part about it is let's actually work backwards, right? Say that this vacation is going to cost you, I don't know, $4,000 all in terms of travel and hotel, and maybe you want another $1,000 for spending money, right? And say that's 20 weeks from now. Well, guess what? You got $5,000 divided by 20 weeks. So now I want you to set up auto deposit so that you're investing, you're saving $250 per week into this account, right? And when it's all said and done, it's going to give you a peace of mind when it's time to actually go on that vacation.
You know, we were talking about Disney earlier and the parks and experiences, and I imagine a lot of families out there are trying to figure out, all right, there's inflation in the mix in a lot of different parts of the experience economy, and even so at the Magic Kingdom and other parks and resorts, how can they adequately adjust even what they are saving for to anticipate for where inflation is still present within some of those services?
Well, I think when it's all said and done, right, the cost of living is going higher, right? The cost of entertainment is also going higher. And so I think one of the things you can do is just put a nice, a good buffer when it comes to saying, I want to have a little more than extra, right? Because the goal when it comes to vacations is not to go into debt, not to dip into your emergency savings fund, right? You want to have a peace of mind. So I think when it's all said and done, if you were expecting to maybe spend $1,000, maybe you want to have $1,500 so that you yourself are not dipping into that savings, not going into those high interest credit card loans that you're going to take out.
Ross, thanks so much for taking the time. As always, Ross Mack, Yahoo Finance contributor.
My man, Brad, thank you. Have a good one.
Absolutely, you too. Much more on wealth coming up on the other side of this short break. Stick around. Stocks gaining back some momentum after a sluggish April. All three major averages are in the green this morning, with the S&P 500 index looking to extend a three-day winning streak. And while investors are broadly bullish on equities, it may be time to add some alternative investments into your portfolio. The alts. Our next guest thinks there are some key reasons why investors should be narrowing in on private markets, especially when it comes to real estate and credit. For more, I'm joined by the man you see right there, Miguel Sosa, Blue Rock Head of Market Research and Strategy. Thanks so much for taking the time here with us in the studio.
Thank you, Brad.
Absolutely. So let's dive right into this. I mean, where, especially within the private markets right now and private real estate, should investors be looking for additional alts opportunities?
Sure. So we at Blue Rock like private real estate specifically. The sectors that we like there are the industrial sector, the specialty sector, and the multifamily sector. And in that order, industrial really is driven by online commerce. More people are buying more products online and they want it at their homes faster. So that's driving demand. At the same time, people don't want the warehouses where those boxes sit close to their homes. So that's limiting supply of industrial warehouses. It's ideal for those warehouses to be close to the homes. So what that does is drive up the lease rates for the industrial space. Now, for the specialty sector, we like the specialty sector because it's such a unique space that's not too correlated to the economic cycle. So for example, if you think of data centers, data centers sit in the specialty sector. And if the economy is doing well, people are going to consume social media content on their phones or on their computer. If the economy is weak, they're going to consume social media content on their phones or on their computer. So it's very resistant to economic cycles.
What are the hottest regions for private real estate right now?
Hottest regions, we're seeing for the multifamily sector, for example, we're seeing a lot of growth in the Sun Belt region of the US. So that's where demographics are in favor, acting as structural tailwinds. So in essence, people are moving from the Northeast, from California, from areas that are really expensive. They want to raise a family. They want to be in areas that the cost of living is lower, taxes might be lower. So we're seeing significant growth there, and that's where our investment thesis is.
What about the interest rate knock-on effects for some of the real estate investments and private real estate investments right now? How is that moderating decision-making around those investments too?
Sure. So it plays itself a little bit differently depending on the sector. For multifamily or apartments, even single-family rentals, it's actually increasing demand for those rentals because people, even those that want to buy homes, can't buy homes. They have to defer, they have to wait to purchase, and so that's driving demand for rentals. In the industrial space, demand for that space is so strong, lease rates are up, occupancy rates are really high. So even if financing costs are high, there's still more than enough revenue to be able to service that financing debt.
Is there like a good rule of thumb or benchmark return that you should be looking for with an investment like this versus, say, the equity market if you're just buying the S&P 500, for instance?
Sure. So probably the most commonly quoted metric within real estate is cap rate. And cap rate, very simply, is the approximate lease rate that a real estate property will generate over the market value. So cap rates have moved up, given interest rates have moved up. Investors are looking for a risk premium. Cap rates will really depend by sector. They may vary from anywhere from 5% to 6% for healthy-ish sectors such as industrial, upwards to 8, 9% for something like the office sector, which is down significantly in valuations, driving up cap rates. So that, though, hides the fact that real estate can appreciate in value as well.
Do you see, and you mentioned the office part of that, do you see office sector portion of this making the same type of comeback that we've seen in other industries needing to make post-pandemic, especially considering the shift in where people are working right now?
It's hard. Yeah. It's really hard. We're not invested in office. We think it certainly went through some challenges during the pandemic. Return to work didn't really play out as investors expected. Occupancy rates are really low, lease rates are going down, and so it's going to be some time before we see some healthiness or robustness in that sector.
Miguel, excellent insights. Thanks so much for breaking this down for us. Miguel Sosa, who is the Blue Rock Head of Market Research and Strategy. Appreciate it.
Thank you.
Well, WK Kellogg, the cereal side of what was formerly Kellogg, is out with quarterly results, and they say a lot about the state of the consumer. Here with more We've got my good friend Yahoo Finance's Shauna Smith pulling up for the conversation.
I know. It's an honor to be on Wealth here with you, Brad, and even more time together this morning.
My goodness, I'm a longtime viewer of Catalyst as well.
All right, let's talk about what we're learning from the consumer and the latest here when it comes to this report that we're getting out from Kellogg, because it's clear from the numbers that consumers are pulling back. And that was my big takeaway so far from Kellogg's results. Net sales for the first quarter, well, they fell about 2% from a year ago. Now, despite that decline, it did, however, come in above the street's expectations. Higher prices helping to offset that drop in volume. So let's get to a critical part of this report. Now, Kellogg saying that its price mix actually rose 6.3% in the first quarter. Now, price mix, it's a very closely watched metric within the sector here, and it includes that the price of the items as well as the products mix sold. So, for example, Kellogg might have been selling more of one type of cereal than the others, and that would have helped that products mix line. So if the price mix here increased 6.3%, then Kellogg is making more money overall. But a key part of this report, though, is also volume. And this is when I'm talking about the weaker consumer here, Brad. This is where this is really highlighted, because that actually fell 7%. So volume is simply the amount of the product sold. So Kellogg is making more money thanks to higher prices. And that, at least for now, is enough to offset some of the pressure that we're seeing in other parts of the business and enable them to beat the street's expectations. So consumers are pulling back on their spending. And this is a trend that we've also noticed in other earnings reports this season. Kellanova, the spinoff that includes Kellogg's snack products like Pringles and Pop-Tarts, well, they actually reported a nearly 5% drop in volumes during the first quarter. Its CEO telling Yahoo Finance that he's working to avoid any more price hikes because of that.
We're working very, very hard on productivity initiatives and other things so that we don't have to take any more price, and in fact can return to promotional activity and merchandising activity.
We've also heard from Mondelez's CEO. He told Yahoo Finance that the lower income consumer is facing a tremendous amount of pressure.
It's not that we particularly want to increase our prices. We would prefer not to, as you can imagine. But the inflationary environment is not easing at all. And so I think the consumer sees the prices, the interest rates, the job market isn't great. Like I said, the SNAP benefits disappear. So they're being hit from many different angles, and it's clearly noticeable that it is affecting them.
So the consumer is under pressure. It's clear from those comments. And even over at Starbucks, customers are starting to spend a little bit less, or at least visit the store less frequently. The U.S. foot traffic at the coffee chain dropping 7% in its most recent quarter. Starbucks CFO Rachel Ruggieri acknowledging the challenges around the customer.
Our occasional customers, we started to see it softening faster than what we had expected. And frankly, we didn't respond fast enough.
So higher prices, people aren't able to afford maybe what they once were just a few quarters ago. We're starting to see that come up in these earnings reports here, Brad. And I think the question here for so many investors, when you take a look at the latest earnings results that we're getting from so many of these consumer staple companies or even consumer discretionary companies in some aspect, is how much pressure is a consumer going to continue to be under as inflation remains relatively sticky? And then also what that ultimately means for these companies' bottom lines here over the coming quarters as well.
And if I got to go back to eating cereal for dinner, I don't know.
I love cereal for dinner.
I mean, it's got to be Cinnamon Toast Crunch.
Oh, yeah, that's my favorite. Wow.
Done deal.
We always agree.
There we go.
There we go.
Shauna Smith joining us here on set for Wealth. Thanks so much, Shauna.
Of course, thank you.
Coming up, is it possible to scale up a business while competing against industry giants? We'll speak with the CEO of Roan, who is trying to do just that next. As a part of our Health is Wealth Week, we're rounding up the biggest health stories of the day and tracking 3 big earnings reports for you. First, Oscar Health shares, they're in the green today. The company reporting first quarter results and beating expectations here as the insurer revealed a 46% year-over-year increase in revenue, which the company says was driven by higher membership, rate increases, and lower risk adjustment. Yahoo Finance reporter Anjali Kamlani is here for this special healthcare themed roundup here.
That's right, Brad. Yeah, Oscar is one of those companies that we know has been sort of struggling for the last several years. It really started that telehealth push that we saw United just drop off. So that's where Oscar plays in sort of an interesting niche. It is still one of the smaller insurance players. It did just get out of the Medicare Advantage market, which we know is pressuring a lot of insurers right now. So it just completely exited. It also plans on exiting a relationship with Cigna at the end of the year, but it is also facing its first profitable year. That is one of the benefits that we saw from this report, a slight bit of profit from the first quarter. That higher than expected membership is coming from a number of different avenues, but in part to do with what we've seen with the drop-off of Medicaid enrollment as a result of the pandemic. So they really scooped up quite a number of them. You can see the stark difference in numbers there. But this is also putting into light the the strategy that Oscar has had. There have been questions about how it can move out of being just a single plan or a single portfolio company, and that is where it has returned to with all these exits. So that is going to be the thing to watch for the rest of the year.
All right, we're watching another stock here today, ticker symbol KVUE. No headache seen with the share price reaction on this one. It's up by about 5.8%. This is the Tylenol maker, Kenvue, reporting earnings this morning. What did they say?
Yeah, Kenvue is also interesting. They've actually been a little bit under pressure because of that spinoff from J&J. This is their start of the first year standalone. They've had a lot of additional expenses, but still good results, as you can see on your screen, beating estimates, both on the revenue and earnings. We're looking at their Aveeno and Neutrogena era. That is, or products. Those are the ones that have seemed to have the most amount of pressure and where they're struggling the most. I actually had a chat with our own hair and makeup folks, and they had some insight on that, calling the products boring. So I thought that was interesting to, maybe if the CEO is listening in, they can spice up the products in their product line.
Good anecdotal data, yes.
Yeah, right. But all across the board, of course, it's a consumer product line now, one of the largest pure play consumer companies spinning off from pharma of the recent ones. So that is one to watch as well.
And then just lastly here, one name maintaining some strength here on the day, ticker symbol HIMS. HIMS and HERS shares trading to the upside. This is after the digital health company beat first quarter revenue expectations, also raised their full year guidance. All right, so what does that tell us about this company right now, Anj?
Another sort of niche company that is looking at its first profitable year. So that's also good news coming out of Hims and Hers. Definitely with the beat, looking at the results there on your screen. This company has made itself known through its quote unquote discrete packaging. That was its call to fame. It managed to increase the number of users and members that are using its products. So that is its product. But I think earnings was a little bit overshadowed by CEO Andrew Dudum's social media posts on Israel v. Palestine. Andrew has said in the past, and he has been a human rights sort of advocate and has posted many times about this, but he did have a tweet out a few days ago saying that moral courage is better than a college degree, using that new age greater than sign. If you're currently protesting against the genocide of the Palestinian people and for your university's divestment from Israel, keep going. It's working, he said, and there will be companies that will hire you. This is, of course, the ongoing protests at colleges against the war there. And so he got a lot of backlash, significant sell-off. He's managed to pare those losses as a result of the earnings results. And in an updated post, as well as the earnings call, said that he, of course, does not condone violence and that students have the right to be safe on their campuses.
Yeah, a lot to really traveling around and swirling around that particular ticker symbol for HIMS right now here on the day. A lot to evaluate. Anjali, thanks for breaking it all down for us. Appreciate it. Well, it can feel quite daunting to scale up your business when industry giants can dominate the landscape. But one athleisure company is doing just that. Rhone Apparel out with a new rebrand as well as a brand new women's line. And for more, let's welcome in Nate Checketts, who is the Rhone CEO. I want to get to the scaling up here, Nate, because one of the huge things that we talk about here on Wealth is how people can take advantage of the market opportunity that's out there, build their own wealth. And one of the ways that you've been able to do that as well, Nate, is in building out this Rhone brand. I want to go back to how you've been able to continue scaling this company in order to make sure that you're taking on some of these industry behemoths.
Well, yeah, Brad, it's good to see you. And we've had an opportunity to chat a couple of times, but you always look fit and well. So great to be on with you. But I think the key for us has been just steady growth. We have not ever been one of those startups that has experienced kind of this lightning in a bottle moment. We've had consistent, steady growth every single year. We continue to innovate on the product line. And most importantly, we really protect our financials and our financial statements from a growth perspective. So the women's launch is an incredibly exciting opportunity to kind of step up to this new level. We launched yesterday. We did have kind of an unbelievable day we lost stock in a couple of sizes and a couple of products that we did not anticipate to happen for 4 to 6 weeks. So we're really excited about the moment that we're having, but it's really just the beginning for us as a brand that's not just for men anymore, but also for women.
When you think about pricing and making sure that you're making a splash and introducing new product to the market, especially with this women's line, how do you go about evaluating that pricing strategy, knowing that this is a market environment where consumers are being more diligent about how they spend and trying to enact smart spending strategies, especially even across what they're wearing in apparel?
I think a lot of companies will start by looking at competition. For us, we start by looking at what is the best possible product we can make for our customer and what is she or he willing to pay for the quality of product. Many companies, I think, will make the mistake of saying, what does so-and-so charge and how can we charge the same or more? For us, it's about the quality of the product. What does the customer want? What are they looking for in that product serving? And we do not compromise on quality. One of the great shifts in terms of direct-to-consumer products has given the customer a higher quality product while being able to protect margin at some of these companies. And for us, 80+% of our distribution is direct to our customer.
Also want to give viewers some actionable tips out there. You've got some aspiring entrepreneurs, people who want to compete in the same space, Nate, honestly. They're out there watching here. But if there was a lesson to your younger self, to your early entrepreneurial mindset that you would give to that younger Nate, what would that be that could potentially instill or inspire a lot of people that are out there watching today?
I think I've grown. When we started, it was kind of this mindset, let's build and scale. And then, all these entrepreneurs were being heralded as building a company in a short period of time. But I've grown to admire entrepreneurs and brands that have existed and lasted for a long time. And so to keep in mind that this is a marathon, it's not a sprint. And we look at the next 20 years. We don't look at the next 5 years. We think about the long-term impact of our decisions. How do we build our customer base for the long term? How do we take good care of our customers and our people? And so just remember, it's a marathon, not a sprint. Don't run out of money, which is probably the number one thing that kills businesses. And keep going. It's not easy.
All right, Nate, always great to check in with you. Nate Checketts, who is the Rhone CEO. Appreciate it.
Good to see you, Brad.
Likewise. Let's do a quick check of the markets here as we close out today's show, taking a look at the Dow, the S&P 500, and the Nasdaq. As you're seeing, all of them hold on to gains as of right now. We're getting more Fed speak over the course of this week as well. Neil Kashkari apparently saying we would do that. Hike is what he was talking about, if needed, if signs of inflation were still entrenched. So we'll see what more comes out on that here. That's it for Wealth. I'm Brad Smith. Thanks so much for watching, everyone. We'll see you tomorrow at 11 a.m.